Committee on Capital Financing and Investments to order. Welcome everyone, and Mr. Treasurer, welcome. Glad to have you here, and Sam, Dave, everybody, we're glad to have you here. Members, welcome. Why don't we go ahead and do the roll call, please?
Yes, sir. For Select Committee for Capital Financing and Investments, September 28th, 2022, Senator Driscoll.
Here.
Senator Guru.
Here.
Senator Hicks.
Here.
Senator Kinski.
Excused.
Thank you. Senator Nethercott.
Excused.
Representative Hallinan.
Here.
Representative Harshman.
Excused.
Here.
Oh, he's here?
Representative Larson.
Here.
Representative Obermueller. Representative Schwartz.
Here.
Vice Chairman Nicholas.
Here.
Chairman Perkins.
Here.
You have a quorum.
All right, thank you. Well, first item on our agenda this morning is performance compensation. So we've got first here, Mr. Treasurer. Why don't you come on up and bring your team, whoever else you want to visit with, and we'll start with you.
Thank you, Mr. Chairman. Well, I don't believe it's any mystery or that practically in every area of state government, we're facing a lot of competition from the private sector and other areas and other state governments. Matt Sackett has done, I think, a pretty good job getting together a historical perspective of what other states have done in some different studies. I think the key in this whole thing here is that we're going to have to come up with some kind of program that's flexible and can be, address those market pressures that we're seeing now and in the future. And so we've got, I think, what the legislature did, previously has worked real well. But as if any of you guys, and I think most of you were at the Treasurers Conference, you know what South Dakota has done as far as their salary structure and their bonus structure. And Matt can go into some of the details on that. Had some good conversations with Matt Clark from South Dakota, and I think, Mr. Chairman, we'll just have Matt go ahead and start in there, give you guys kind of an update and maybe add to what Lisa Jordy Spillman did up in Casper. And we'll kick it off, I guess, with a conversation about how do we address these market challenges.
Thank you, Treasurer Meyer. Chairman, Vice Chairman, members of the committee, Matt Sack with the State Treasurer's Office. I wanted to quickly start with that PowerPoint, which is really kind of a revisiting of the information, as Treasurer Meyer said, that was presented last meeting up in Casper. I wanted to focus a little more on the Texas study, and then RVK actually provided us a Pennsylvania study, which you have both of those actually studies were given to you guys in your documents. So starting with the PowerPoint, going to page 2, basically financial and investment compensation generally falls into 2 categories. There's basically a straight salary, base salary without performance comp, and then there's other systems that include a salary which is generally lower, but then has performance compensation built within it. Overall data on comparisons is pretty difficult because there's so many variables. It's even harder in the private sector because they guard those more closely than in the public sector type of information. So moving on to the next slide. This is all based from that study that our general counsel presented last meeting in Casper. So those are the studies. I wanted to keep that the same, except for then to the next slide. Next slide, Karen, thanks. So this really takes those studies and combines them to come up with an aggregate comparison. I think big picture here, the 4 columns on the left you see are the accounting positions. Those were generally in the neighborhood, although I think in the last few years, anecdotal evidence from some of the private accounting firms that we talk to have also indicated they're having trouble hiring accounting staff. But generally, those appear to be close. Those middle 3 columns are the CFO, kind of the chief legal position, general counsel, lead investment attorney, that type of position. And then the COO, the chief operating officer. You can see those brown columns are much taller. Those are the comparators, and the yellow columns, which are our salaries.
Go ahead.
Do they take in for your accounting staff and stuff, do they take into account what we've done this last session, Matt?
That's a good question.
On employee compensation?
Mr. Chairman, Representative Larson, no, it does not. These are based on last year.
Do we have a feel how that would look across?
So the accounting staff would have been bumped up a little bit. I think those are still generally in the market. The CFO position would have been bumped up a little bit. But I think overall, big picture, they're still well below the market. Chairman and Representative Larson.
Yeah, Mr. Chairman, I think it's appropriate too to look at the notes there where it says the comparative salaries were discounted 15%.
And, so 2 questions. Which one is why'd you discount 15%? And then 2, are we looking at base salary or looking at total compensation, including the incentive comp?
Mr. Chairman, good questions. The 15% was an attempt by general counsel previously to get to a cost of living change, although these studies are varied and across. So that Texas study had 16 peer groups within it in the retirement system. So it gets a little convoluted. The 15% was an attempt to bring it down to a lower cost of living. We're obviously not California or New York, where a lot of some of these financial institutions are, but a lot of these are retirement systems, so also within the Midwest and other places. To your second question, these are base salaries.
Right. Thanks. Keep going.
So moving on to the next slide is really just some excerpts out of and we can go through these pretty quickly, excerpts out of the Texas study. And that first slide is really just showing the accounting staff. You have kind of investment accounting, which I think is an important distinction for the treasurer's office. We're not looking for green accountants right out of school, because this is a lot more complicated accounting, and I don't know the details. We could talk to the people behind me, but we're looking for people with three years experience or something and knowledge in the investment world. So investment accounting, you see their mid-range 75,000. Then you have investment accounting 2, they're 87,000, and moving up to an accounting supervisor. On to the next slide. Really is a discussion about the legal staff and director of finance, or the CFO. This is where I think you start to see the divergence from what we pay and what their mid-range point salaries are. The director of finance is 181,000. The lead investment attorney is 195,000. And these are the recommendations from the study to the Texas Municipal Retirement System. The general counsel, so our chief legal counsel, 216,000.
Yeah, Mr. Chairman, that was in May 24th of 2018, so this study is a little dated.
Go ahead.
Thank you, Mr. Chairman. So we're comparing to retirement systems, and I know reading about the Pennsylvania, they're fundamentally autonomous and not subject to legislative approval on their salaries. Do we have comparatives to investment that are overseen by legislatures?
Not nearly as many. And I thought this was somewhat relevant because we already have a retirement system talking after us, even though they are still tied. So it gets kind of complicated when you're looking at compensation, performance compensation, how those are built, which I have further probably discussion points on some of that. But New Mexico is probably similar. They actually pay less than us and don't have performance compensation, and they're losing people right and left. Steve Moyes presented at the annual conference, and talking with him, it's very hard for them to keep staff.
And New Mexico is overseen by the legislature?
I think they are. I would have to confirm with Patrick. Are they?
13 board members.
Thank you.
Which does have some political / legislative appointees.
Okay.
Moving on to the next slide is really an excerpt from the Pennsylvania study just showing really investment staff. They fit in that first kind of category with just base compensation, but you can see the ranges there that they pay. CIO $303,000 base pay, but does not include performance compensation. So I think generally in summary for the next slide, comprehensive compensation comparisons are difficult because the data is just not readily available. I think generally it's worked well so far. As you all know, we've had one investment staff person leave the office, and then one general counsel has left the office. So as the gap between current compensation and market comp grows, staff retention might become more of an issue. I think overall these slides indicate that the office is below market for both the front and middle office. And as I said, some evidence suggested in the last few years, market salaries have increased substantially, even for back office accounting staff, which might mean we're moving even farther behind the market. And as Treasurer Meyer said, I think compensation and for state employees, they've heard from other agencies as well that we're behind. And there's a variety of performance comp models, but variety of compensation and performance comp models, but ones that don't have performance comp generally have higher base salaries. So I think generally that was to try and revisit some of those studies, but generally just show that salaries are behind the market. But I think talking to LSO staff, there were some general questions, which how is performance comp going? We didn't get into that as much the last meeting. So overall, I think it has been going well, but maybe it should be had been going well. As you all know, Lisa left and Matt Schmagosh left. So that's one person that had performance comp and our senior investment officer, and one person without performance comp. So Matt Schmagosh took a position at a private office, and with a substantially higher salary, upwards of the $600,000 plus performance compensation, plus like unlimited vacation, plus fully remote work. So all the benefits. So I think generally speaking, performance compensation plan as an asset to keeping investment staff, as generally most staff have reached their performance benchmarks. The senior investment staff that left did not actually receive his full performance, but like I said, I think it's more about his future opportunities than the performance compensation. And talking with our consultant, RVK, they had some general observations from their clients and experiences, but noted there's no good industry-wide data to make any real definitive statements, kind of reiterating that the data's, it's really hard to make big picture assumptions.
Go ahead, Representative Schwartz.
Thank you, Mr. Chair. So in these other systems, do we have any information about other benefits to employees, like remote opportunities for remote work?
Mr. Chairman, Representative Schwartz, no, not really, especially with the remote work becoming much more of a new thing. Most of these studies are pre-COVID. There was still probably some of that, but that's as limited as the data is, there's even less information on those type of scenarios. I know there are consultants that you can hire that maybe have those things, but those aren't free for the public. I know RBK has actually done some studies for other companies, and they do that as a contract, kind of like we did on that 244 study. So they have a staff dedicated to do things like that, but those come at a price. But that could include interviews with, but not generally open public information, I guess I would say.
Right.
Mr. Chairman.
I mean, I would only comment, you can always hire a consultant for anything.
Yeah,
Yes, Mr. Chairman.
Mr. Chairman, we are, I guess, entertaining and doing some due diligence on the possibility of our, in replacing Matt Smagosh, of having a hybrid, and looking actually of some candidates that are in Jackson. And because frankly, that's where most of the expertise lies. And so there's a possibility of a candidate there then, but we're trying to, I guess, we're having some discussions to see what might work, looking at possibly of a hybrid where they have to be down in Cheyenne 1 week a month, but they still have to work 5 days a week. And there's ways without being interfering to find out whether or not the person's actually working. So, and the private sector does, I mean, the private equities is a little bit different type of an asset than the stocks and the fixed income, because there it's a lot more of a collaborative process. In private equities, it's more of a personal process of the individual, but they still need the same backup. The analysts, the accounting system, and all that has to be integrated. So, I think if we're going to get the best person in that, that we should be able to look at that. And frankly, Matt Smagosh is working in 100% from home, and has not on-site analysts, but has access to the analysts until that backup part. And so that's what the private sector is doing, and we're looking at whether or not we can, as a public investment area, actually kind of adopt some of the private sector protocols and see whether it's functional. I think it probably will be, but it's going to take a little bit of time to figure out if that'll work.
I would just, speaking from personal experience with Jackson, make sure that you do a good job with the powder clause in a contract, because it does create problems for employers in Jackson.
Yeah, that's one of the clauses that we know we're going to have a problem with this particular individual and some other people that might step up, because well, they get so many vacation days, and I guess if they take a powder day off, they take a powder day off. Yeah, I understand what you're saying there, Representative. Thank you.
Okay, thank you. Anything else? All right, continue.
Mr. Chairman, I thought Kurt had mentioned Matt Clark from South Dakota Investment Council. I did have a nice talk with him just the other day. He's a busy man. He's hard to get in touch with, but he presented at the Treasurers Annual Conference and discussed some of this. But I did have a nice talk with him and fleshed out some more details. So South Dakota, the CIO makes $556,000 base plus up to 200% bonus. There's a deputy CIO who makes $356,000 base plus bonus. All the staff can get up to 200% bonus. There's 3 staff that are kind of a sub-deputy type position. They all make $300,000 plus bonus. So all of those positions make more than our CIO base.
Yeah, and I talked to Matt, he said that they got a bump this year up to 225% bonus of a potential. So it was either that or they added 25,000 to the 260. Yeah,
They're working on
Yeah.
getting it to 225, but that's
Yeah.
still within the legislature.
okay.
They also have 9 senior portfolio managers who make 259,500 plus bonus. And generally, as you work up from a junior staff up to there, that's about 18 to 20 years of experience. And then, of course, additional probably experience for those top positions. Down to their junior staff, which are generally right out of college, they receive $65,000 plus bonus right out of college. So specific to their performance comp plan, they can make up to 200% of salary. But Matt said, generally speaking, on average, they get about 80%. So their performance comp is pretty complicated. They have, various different stretch goals, personal portfolios, et cetera. They have 1 year, 4 year, 10-year kind of comparison. So it's fairly complex. Overall, Matt says or CIO from South Dakota says that they figure their compensation is about 60% of the private market. So and they're substantially above us. So I did actually calculate out this morning. So the CIO making $556,000, 80% on average comp means his total compensation per year is $1 million. For that deputy CIO position, total comp's around $640,000. And the sub-deputies are around $540,000. That senior portfolio manager is $466,000. So that means that our CIO makes somewhere between the sub-deputy and the senior portfolio manager, assuming that our CIO makes full bonus. So
Mr. Chairman.
$500,000.
Go ahead, Mr. Vice
Matt, could you put that information, I'm not going to try to write down these numbers and stuff. And then the other question is does South Dakota actively manage their portfolios? Are these investment staff actually doing trades, or are they just managing other firms that do the investment?
Mr. Chairman, Senator Hicks, good question. They do a lot of
In-house
active
trading.
internal trading, mostly, I would say.
Yeah, essentially, they've got an active senior investment officer for every section of the market. So they've got 10 of those at $260,000 apiece, and then they've got backups right down the line on that.
So
I think their total. We can get you the assets under management, and I think Matt, you've got the total number of employees there, don't you?
I don't have the
I
total
think
number.
I think just in the investment thing, I think it was 34 just in the investment thing where, we got a third of that.
Mr.
Less than a
Chairman,
third.
but it would be helpful if we could get how that compensation program works. Just that you indicated it's complicated, but it should be complicated when we're talking those kind of numbers, and
Yeah.
it should be merit-based. So if you can get that information for us, and sooner than hopefully, before our next meeting, take a look at that stuff. I'd be really interested in taking a look at that.
Yeah.
So thank you.
I think kind of the short, long-term goal, whatever, is to get a little more flexibility that allows us some in-house promotions rather than having to go clear back to a legislative process to get somebody to go from junior analyst to mid-level analyst, those type of things. Managerially would function, I think, quite a little bit smoother. Then we have to look at, what's our goal going to be? Are we going to be 60% of market on the private market? Are we going to do 50%? Are we going to, look at 50% of the salary and then look at the bonus, or 30% of the salary and have a larger bonus. Myself, I think that you have to have, probably this, at least the salary that we have now, or a little bit more, but I think we're gonna have to look at that bonus structure, because it seems like that's where the competition seems to be really moving toward.
Yeah, Mr. Chairman, I don't disagree with that, but it can't just be based on straight percentage.
Yeah.
When you look at the cost of living to live in New York and work on Wall Street, it's a little bit more of an
Definitely
Cheyenne,
merit-based.
Wyoming. So all those things would have to be calculated into those, other than just a straight percentage. And
Yeah.
Mr. Chairman, with regards to, having the authority outside of within the office to make those adjustments in salary, Mr. Treasurer, you're talking like a treasurer now versus the past legislator. So
Always
you
with-
used to sit up
always
here,
with sideboards.
you know the answer to the question.
Always with sideboards, Mr. Chairman. I think that you can have flexibility, but you don't want to give people enough rope that they're gonna hang themselves. I guess I'll say that, yeah.
Sounds like the Goldilocks solution. Go ahead, Representative Schwartz.
So kind of following up, so we're looking at a cash comparison here, right? Do we ever do is it done on a BPS basis in terms of how it relates to the size of the return, in Texas? I mean, do you understand what my question is?
Yeah, the basis points, yeah.
Mr. Chairman, Representative Swartz, generally basis points is based just on the assets under management. So there's even less of a tie from what I could identify in talking with RVK in terms of having performance comp and how your actual performance is. There's been, discussions that if you're just trying to beat a benchmark, then all you do is beat the benchmark. So some places that are just total salary, believe that this is your salary and go do, don't just beat the benchmark. So quality is, there aren't any studies that are definitive, I guess is, I don't know if that answered your question.
Yeah, right. I guess when you look at basis points funding, and I'll put it in an analogy that I think most of you guys can understand. You want to have basis points funding that isn't as high as what we had when we had coal bed methane funding, because then you can't, responsibly, you can't waste the money. You just can't do it. And that's what happened during coal bed methane. And if you had 30 basis points, that would be ridiculous, amount of money to look at it. And I think that you can put some parameters on, I think, the growth of salary, the growth of positions, but not necessarily, if it's gonna work right, I think you have that in percentages and not in actual numbers, so people can stay within a reasonable growth assumption. And that growth assumption really is, as your assets grow in value, then you have more capacity to bring on more people, which you need to manage and account for the money and to invest the money. So, and you're right, Mr. Chairman, we got to try to find that Goldilocks number there that would allow for that flexibility. And if you have it capped, then you shouldn't have any areas where you're going to have a lot of, I guess I'd say, wasted the funds, and they wouldn't be appropriately applied, because you'd have to make the decision, well, you've got this amount of money, how many positions does it take to actually manage that correctly? And then that drives your salary structure, to a certain extent. And so I think there's a way, I think, to look at that, put together some kind of a 5-year plan and assumption, and actually cost it out, work your way back into that basis points. And it's somewhere between, I think it's somewhere between 10 and 15 in our case, and I think that would take care of all of it. I think the 15 would be heavy, and the 10 might be just a little bit light.
All right, thank you. Anything else? Any other questions?
Mr.
Anything else,
Chairman,
Mr. Treasurer? Matt?
Yeah, a little bit on ESG and some of the things that are going on in a topic that I've approached with some of my other state treasurers and some of the comptrollers is proxy voting. And Florida has just, they have a system where I think the governor, the AG, and another elected official can basically authorized or instructed all of their funds to the extent allowed by law to come back, to bring all the proxies back in-house so that they can vote all of those shares in a manner that makes sense for Florida. And what I've been working with on the national basis with some of the treasurers, and we've got a committee with the SFOF set up now that's going to look at the legislation and different things that it's been going on with proxy voting and see what we can or can't do. There are some institutions out there that necessarily that's all they do, is that they vote proxies. And there are some of those companies that are more conservative than others. And so we're going to look into, the structure of what happens, in the retirement and like the 457 plans and all the BlackRock plans that we have there, those time plans, and then into all of the other areas where we may have the ability to do proxy voting. So I think it's going to take about a year or two, or to really get our hands around all of it on a national basis. But there may be some things that we can do, in that interim time period. And I think probably the best way to do that would be to, have a treasurer recommendation to put that within our investment policy and have it voted on by the SLIB. That's how we handle WildStar 1, WildStar 2. I'm assuming the constitutional amendment passes, you probably handle that probably the same way. But yeah, I think it's time, from my perspective, that we actually, use the powers that we might have to influence the outcomes in some of these areas. But the main goal, and we don't want to ever lose sight of it, is the main goal is that we're there to get the highest risk-adjusted returns, irregardless of the political influences that might be exerted on the office. So, we keep our eye on the ball, but then again, we want to make sure that if there's a optionality where we can move the needle in other directions at the same time, making more funds.
Yes, go ahead, Representative Larson.
So are you telling me, Treasurer, that regardless of the political influence out there, that it's just all on investment? So if we were investing, let's say, in where an investment went to a country where there was gross human neglect or problems there that just goes against our moral compass completely, that we ignore that and just keep our eye on the investment?
I think it's the other way around. I don't think that's what
there are lines, and one of the lines, I guess, that I looked at was in the area of Russia and Ukraine. From our perspective, it was one of the first things that when that war broke out, I said, I want to know, how much money we've got invested in Russia and how. Now, most of the money that was invested in Russia, and I think we had less than $50 invested ourselves in Russia in our internal investments, but there was quite a little bit of money in some of the index funds that were attached to it. And of course, the values of those went down so fast they were almost worthless. They popped back up some, but yeah, we looked at it to see whether or not there was something there, and what the cost would be, and we costed it all out. And I don't know, I don't think we costed that out recently. But yeah, there are things that you shouldn't do, but our first thing is to keep our eye on that ball and making the money. And then when these things pop up, you do an analysis about, you know, the cost-benefit relationship. I think we're kind of short in Asia, and that's just because I think we had our eyes open, or Patrick had his eyes open when all that real estate stuff was going on, and we didn't get into some of those things.
Follow up, Mr. Chairman. And thank you, Treasurer Meyer, because, yeah, and I appreciate that. And I kind of bring that up, and I know that my example was way out there, and I know that you have a moral compass, and I wasn't trying, I'm just trying to lay the path, because we just come from the Energy Council this last week, where the impact of the financial community on our energy industries to be able to get loans is really being felt. And there's a real concern within that community that the investors could perhaps push back more than they are. And so is there anything we can do to help in that accord? Because that's a key component to our revenue, and I know that you're working on that. So if you can just give me a little help there on what we can or what you are doing in that regard.
Well, what we're doing now is that this committee is going to work with some national organizations that have been pushing back on ESG for a decade or more, and find out, you know, what the legal lay of the land is federally, and see what we can or can't do. But I think the way I envision of pushing back is actually getting to the point where you've got enough clout between the different states and the different retirement funds across the country that you can actually start pushing back at the board level. I think that's, and you know, as soon as we're effective, you know, the same thing is going to happen with the other side of the equation, you know. But I think that we have to at least be able to have more ammunition than we do now, because we've been sitting back, I think, on our hands, and I think a lot of people got caught flat-footed on this, on the energy thing. But in the long end, you know, the long and short of it is that when oil was $100 a barrel, people were starting to get loans, and they were starting to drill in Wyoming again. Oil goes back down. A lot of this is market-driven. I think a lot of the financial institutions, if they've been lending in energy area and they dropped out, they might have gotten rid of their entire section in their banking system to even have the expertise to make energy loans. So there's another problem right there. I think the number of people making those loans is probably a lot less now and than it's probably ever been, and I don't know if people are going to jump back in it. I think it's going to take for energy, I think it's going to take some alternative financing areas, and I think a lot of that might be private credit.
Okay, thank you. Anything else?
Mr. Chairman, maybe just to put a quick little bow on the end of the performance comp stuff. So I think if you want to change performance comp, or like the investment staff side, we can change salaries, or you can change performance comp. And that'd probably be easiest done by changing the percentage payouts. Right now, the junior staff receive a 25% max bonus up to 100 for the CIO, so those could be changed. You can change the base salary as well for non-performance staff, legal, CFO, etc. Those would have to be done through the state HR department. And I did talk briefly with WRS. We might be able to meet before the next meeting, have some discussions, and maybe come back with some more specific ideas.
Okay, thanks. I mean, which is the whole point. That's why I want to look at this. We had it in place. Now we've got some experience with it. What does it look like? If we have it right? How badly did we miss it by? And we've missed it by some. Yep. Yeah.
Mr. Chairman,
Go
real
ahead.
quick on that,
Vice
whether we do either one or both or a combination. I guess I would be curious to get some recommendations out of it.
Well, this is, you know, I think that's an interesting thought. I think my vice chair, the vice chair had some ideas along that line as well.
Thank you, Mr. Chair. So I think what that I'm going to recommend that this committee do is, you know, we have a working group committee right now. We put together that, and we've got a report which takes care of most of the duties of that working committee. So, Mr. Chair, I would suggest that we continue the working committee, and that working committee then will make a specific requests to the Treasurer's Office, to retirement, for specific information that we want to follow up on. And then as part of that committee, we'll also basically ask both entities to come up with 2 or 3 different scenarios or recommendations that we will review, and then kind of work through those and come up with a tentative 2 or 3 recommendations that we'll bring back to this committee for alternative options for that.
That makes sense to you, Mr. Vice President? Absolutely. Okay. That makes
Mr. Chairman,
Treasurer?
I'll put a pitch in for the WRS. They really do need an analyst over there. They do. And probably another accounting position.
Just, are you offering one of yours?
You know, if we can't get this, well, we only got 1 accounting position to fill, you know, so, and I think we'll get it filled before you guys go into session, so.
All right.
Thank you, Mr. Chairman.
Thanks so much. Appreciate your time. Okay, so speaking of retirement, retirement system.
Good morning, Mr. Chairman, members of the committee. I'm David Swindell, the Executive Director of the Wyoming Retirement System. I'm joined by our Chief Investment Officer, Sam Masudi, and I believe we should have on the Zoom our Board Chairman, Tom Chapman. LSO, do we have him available? I'm seeing a nod, so we do. And so, Mr. Chairman, I think what we'd like to do, if it's okay with you, is we'll ask our Board Chair to make some introductory remarks.
Thank you, Dave. Thank you, members of the committee. Good morning. My name's Tom Chapman. I am chair of the Wyoming Retirement System. I first want to thank Senator Driscoll for hosting us 2 weeks ago in Hewlett. The entire board, the staff, everybody thoroughly enjoyed it. And even though it was about an 8.5-hour drive for me, can't say enough nice things about the town, the people. Anyway, I just wanted to say thank you. So we're going to be very brief today. A lot of this, I think you kind of already heard from previous meetings, but we have beaten our benchmarks and have beaten our performance comp hurdles. Just remember, what is the purpose of performance comp? It was to improve our returns, increase our stability of our people and our staff, and encourage recruitment. So in terms of performance, we've had a bit of a Sports Illustrated moment, if I can use, or a Wheaties box sort of thing. WRS, in terms of our performance, if we look quarterly, year to date, 1 year, 2 years, 3 years, and 5 years, we are top quartile, and our worst performance is the 19th percentile, which is incredible, particularly when you think about with the markets of where they've been, you know, on a 5-year basis of a bull market, and in the last year or so of being in a bear market. What's really important, frankly, is our risk, our return to basically the units of risk that we're taking. So, you know, are we taking extraordinary amounts of risk? We look at that through an indicator called a Sharpe ratio. And our 5-year Sharpe ratio is actually in the 15th percentile, one of the top out of 62 other pensions. Let's just take a look back at sort of how much this has improved. In 2016, our 3-year returns were in the 85th percentile, our 5-year returns were in the 89th percentile, and our Sharpe ratio on a 5-year basis was 96th percentile. So we've made, I think, incredible improvements. Going down the list in terms of increasing stability, We've had no staff turnovers and no one's left. And in terms of recruitment, we've frankly gotten a few folks that we probably wouldn't have gotten in the past. Now, I will say, kind of maybe ducktailing a little bit off of Treasurer Meyer and the Treasury discussion, we are concerned. We are in the fourth quartile as far as base pay across our investment staff. We do feel that there probably needs to be adjustments with our base pay. One of the things that I would like to say, though, and having come from a recovering Wall Street guy, is you generally want to pay people for what they can control. So the idea would be to pay, I guess, a higher percentage of their total compensation with performance comp, say at the higher end of, say, the chief investment officers, senior investment officers, but the analysts, the investment analysts, you generally try to say that you probably want a higher base salary, but not as much of a performance comp because they can't control as much. I think what it's critical right now is the S&P is down 22% year to date. It is critical that we hold on to staff and we try to get the best staff possible, because one of the things when I joined the Wyoming retirement system, we were still recovering from the great financial crisis and the amount that we lost. So the ideas in markets like these is to try to lose as little as possible rather than necessarily trying to gain as much in the bull markets. So I encourage the subcommittee, CapFin committee, to really look carefully at this, because I do think that we need to do something in terms of our base salaries. But overall, I think our performance comp has worked really well. And I think that the Wyoming retirement system has done a great job. Sam and the team have done a great job. But again, I assert caution that given the market environment we're in today, we need to be extra vigilant in making sure that we have a solid investment team. And that goes for both, not only retirement, but the Treasury. So thank you, Mr. Chair. Those are my opening remarks.
And thank you, Tom. With that, Dave?
Thank you, Mr. Chairman. Just to summarize just a couple of things and remind the committee. Since we last met in Casper, performance compensation, all the final numbers did come in, and as we predicted, yes, they earned a full measure of the performance compensation for our investment team. The value added over a 3-year period is calculated at $444 million. I think Board Chairman Tom Chapman recited for you pretty accurately the numbers that are in your packet. We've done really well compared to our benchmark, really well compared to our peers, and it is a remarkable change of events compared to, say, 10 years ago. And I think Tom pointed out that we achieved these results without excessive risk if you look at measures like the Sharpe ratio and so on. I do want to remind the committee we do follow a process, and we have done that. The investment team, calculated all this stuff, but our internal accounting department reviewed all that. It was also reviewed by our internal audit department and the board's independent investment consultant, and all that documentation was provided, and we've sent that to the IFC for their review. And I think everyone has responded except one. So we're pretty much through with that process. Over the past year, there's been no staffing changes on the investment team, so that's progress on retention. And Mr. Chairman, Tom mentioned the situation on base salaries. I do want to remind the committee that the investment team did not participate in the governor's pay plan that was adopted in the last budget. So their salaries are capped by the footnote that was adopted in 1 July 2019. So that's more than 3 years ago. Most of those salaries, by the way, were actually codifying salaries that were in place for the year prior. So Sam, your senior investment officer's last base pay adjustment was in March of 2018, more than 4 years ago. So those salaries have remained flat for 4 years. Inflation since 1 July 2019 through the last measurement last month was 15.4%. And if you figure that it's going to be months before another footnote takes effect, 1 July of 2023, really a base pay adjustment of at least 20% is indicated. So those are the kind of numbers that you're probably, I don't want to be shocking everybody, but that's kind of the scale that we're probably looking at just to sustain what we've had. I do think that the bases are important in the performance comp. If you look at the structure, of course, it's pretty obvious that the base is really the foundation of the program, and you've got to maintain that foundation. And I believe that was a discussion of the Joint Appropriations Committee. I think Representative Nicholas indicated that during the supplemental that would be attended to, and that was a good discussion. So we look forward to that. A couple of other things I might mention that came up previously in the previous conversation. There was a discussion on remote work and how employers are handling that. At the National Association of State Retirement Administrators, NASRA, it's basically all the executive directors of the big statewide pension systems. We finally had our first conference together after 3 years of not meeting because of COVID. And we had a session on that. And I think there was about 35 of us in the room, so most of the states across the country. But anecdotally, what did I get out of that? Most states are allowing some form of remote work for their employees and especially their investment staff, which has long been set up to work remotely because they're oftentimes on the road to the investment centers in San Francisco and New York. And we of course offer that. We have intermittent telework agreements with all of our employees, and they're used pretty heavily in the investment staff because they are traveling, and that's the nature of the work. And Sam does a really good job of organizing that. They have frequent Zoom meetings, and it really doesn't matter whether they're at home or in the office. There's a couple of challenges. A lot of the systems were having some legal issues with their payroll departments because when you start basing people permanently out of state, you get into paying the other state's workers' comp rates, others withholding for the other state's income tax, and all those legalities. As it turns out, many states, state governments are not really set up to be multi-state employers, although in the private sector, they deal with this all the time. There are some exceptions to that, and it goes by the same places you would think. I talked to the folks at New York State. They didn't have too much issues with it because if you think of the tri-state area, if you're familiar with the New York City, New Jersey, Connecticut area, that's a tri-state area, and they've kind of worked this stuff out a long time ago. Same way in Northern Virginia, Maryland, the District of Columbia. That's an economic unit, and those three entities kind of know what the others do, and their payroll departments and lawyers, they're all set up for that. But for a lot of states, this is something new. More common is the folks like in Texas teachers that had expanded their employment and offered remote work across the state of Texas. Of course, that's a big place. But rather than relying just on the labor market in the state capital in Austin, they were allowing people to remote from El Paso, Dallas, Houston, and so on. It's all within the state, and so they were having some trouble getting the state payroll department to go outside of Texas, but for the moment, they said Texas is big enough, we don't need to do that. So I think in general, the landscape looks like most of us are being able to offer at least intermittent telework within our state. Some states are more progressive in having all the agreements in place to permanently base people out of state. I think our situation is probably, it's the Jackson market where some finance folks decide to relocate. I think that's easy. The other finance market that we'd probably like to access at some point is probably Colorado. Folks living in Denver, and that would require some changes to the state payroll system to withhold for Colorado state income tax and all those legalities. But everybody also said if you work it, you can work all through those things, and some states had reported that. So that's the update on remote work. The other thing that was discussed that was gross violations of where you invest in the world and Russia and gross violations and so on. As was stated, our goal is to make money for our members. The pension fund is for the exclusive benefit of those members. and we don't engage in any attempts to use the portfolio for any measures other than that. However, there are gross violations, and those are kind of dealt with two ways. First of all, there's places like Sudan that have been sanctioned. It's so gross that the federal government has had sanctions, and of course, we obey those sanctions. That's an illegal market for our managers. It has been for some time. And then there are, newer stuff like Russia has now been sanctioned. And so we obey all those things. So it's gross enough to come to the level that those investments become subject to illegalities, then of course we obey those sanctions. The other thing I would remind the committee is that the market's pretty smart. A lot of us did not have a lot of money in Russia for a variety of reasons, mainly because the market judged it to have high geopolitical risk, and of course that risk manifested itself. The market kind of understands too that if you're close to a gross violation of human rights or so on, that it's apt to have some geopolitical risk, and that's reflected in the investment opportunities, and smart investors back out because it's reflected in the market. And that was true for us. I think we had 0.1% in Russia, and because mostly in the energy, in the index funds. And so we didn't have a lot of exposure there because the market kind of guided us away from that. And I think that concludes my remarks. Sam, do you have anything to add?
Yeah, I just want to stress, I think that I say this, Mr. Chairman, say this every time I speak with you guys. We're very grateful for this program, and it's been a big lift. I think grateful to the committee, and I think especially Representative Nicholas. I know you were spearheading this 5 years ago, and you spent so much time on this. We appreciate it, and it's been enormously helpful. And I think that we can gather market about other plans to try to understand their compensation, but ultimately market means what we need to pay to attract people to work here or to retain people. And specifically with retaining, we don't know what market is until someone comes to us and says, hey, I got this other job offer and it's paying X amount, and we have to figure out how much to pay them to get them to stay. That's when we know. I think in terms of hiring, there's some indications we might be a little bit low just looking at what Treasury's experience. So they were trying to hire a fixed income person. I think it might have taken them 15 months. Is that about right? And trying to hire a private person or hedge fund person, someone in alternatives. And I think that the resumes they've gotten haven't been great so far. So that's something to be aware of. And I think, if you look at our returns over the last 3 years, we've produced about $450 million in excess profit above a benchmark, which was not easy to beat. 2/3 of our peer set wouldn't have beat our benchmark. So it's not an easy one. And I think this is a little bit, if you think of you own a really nice car, there are two strategies for changing your oil. One is to change it regularly. The other is to wait until the engine starts making funny sounds and then change it. And oil changes are cheap, replacing engines is not. So I really appreciate you looking at this and looking how to make tweaks so we stay ahead of this. And if you think about our big picture, we have about $2 billion in unfunded liabilities. And at our current pace, that's going to close over time. But there are 3 ways to close that gap. One is by increasing contributions, which is really painful, obviously. The other is by cutting benefits, which is really painful. And usually there has to be some makeup in terms of cash compensation. And the third way is through investment earnings. And I think that with enough resources, we can continue to produce that outperformance. It's the least painful way to go, especially when you look at our budget. So our budget is about $2.5 million, and that's all in for consultants and everything. And so it's really a very low cost relative to the the potential upside there. And Mr. Chairman, if I might, Representative Schwartz asked a question earlier about related to plans and how many have compensation set by the legislature. And there's a full range of approaches, and there are pros and cons of both. On far end of one spectrum is where the board determines the budget independently. The executive director determines salaries, much like a private corporation would operate. And on the other end of the spectrum is, the legislature determines salaries by position. And I'm guessing that's maybe 10% of pensions have that, but it's really across the board.
Okay. Thank you. Go ahead.
Well,
Mr.
while we got them here, just a couple of quick questions, and then maybe a suggestion that the committee may want to look at is for my 12 years in the legislature, I've been concerned about the $2 billion of unfunded liabilities associated with the actuarially soundness of the big plan. And we can always project out 30 years. We know the increased volatility we've seen in the last 20 years. And so I'm just curious as to, I haven't seen the latest update, but where are we at would be my first question, because it seems like 2 years ago we were about 74, 76% actuarially sound. Are we still, given the radical shifts we've seen in the last 2 years, where are we at on that would be the first question, Mr. Chairman.
Thank you.
Mr. Chairman, Senator Hicks, good question. As of 1 January 2022, the fund was rated at 77.0%. That is partially due to the fact that, once again, we moved the goalpost because we assumed the board adopted a lower rate of return going to 6.8, but on an actuarial basis. And by actuarial, that means that we're smoothing the asset returns. We smooth over 5 years, so we only booked 1/5 of last year's 17% gain, and so on. So right now, market value is like 86%. But the reason you smooth is because you have episodes exactly like we've experienced. So I've run a little model on it. We're probably going to have a market loss this year. What's going to happen to that 77.0% if you lose, say, 10%? If on 31 December you close the books and it winds up you've lost 10%, that's your return. Well, the answer is the actuarial funding ratio on 1 January 2023, when those reports come out, it would be 77.1. It'd actually go up 0.1%. Why is that? Well, it's because you had so much in the bank versus market value. Now, the long-term projections move quite a bit. When was it you were going to get to 100%? 13 years? Call it 23. It'll move by a decade or more. So you'll see those projections move quite a bit, even though the near-term stuff won't move. And the reason for that, of course, is if you take what the actuaries do, they'll say, all right, you lost 10% from here. We're going to assume 6.8% for the next 10, next 20, whatever time period you're talking about. And if you take a look at that and you put in a -10 and then say 9 years of 6.8, you have an average 6.8, right? And so they can't predict a market rebound. At some point, if you're going to achieve an average of 6.8, there will be a reversion of the mean, and the markets will come back some. So we remain long-term investors, but that's our situation now. How does that compare to other pension systems? Again, I was at NASRA, and they always get lots of good statistics. The average pension in the US is about 74%. And a few percentage points really don't matter that much. These are all within the same grouping. In general, Wyoming's pretty much very much close to median in most of the metrics. And most pensions have been stuck in the mid-70s for the better part of the decade for all the reasons I just cited. Volatile investment returns, but a lot of reduced assumptions. So at least it's a more conservative setup than it was.
So, Mr. Chairman, I think it was 2 years ago, I think there was a bill in the Senate that actually looked at trying to move that actuarially sound this up a little quicker. And it required some additional contributions by the state and also by the employees. And I just wonder if there's any appetite to this committee to take a look at that again, as far as trying to move that needle, because I think that Director Swindell was right. We've been stuck for a decade right here within 2 or 3 percentage points of what actuarially sound this is. And so it's a $2 billion liability that has a 30-year horizon. But if there's any appetite, I would like to see us take a look at that bill and see if it's something that the committee would want to sponsor at our next meeting.
I don't know that you and I get a vote.
So,
Go ahead.
Go ahead, Representative Schwartz.
It's kind of a related question, but when I've looked at this notion of 100% funded based on actuarial projections, I think of that as aspirational as opposed to, for lack of a better word, realistic in relationship to what we really need to guarantee that members have no reason to be concerned about the state of the fund. So do you have comment on that?
Mr. Chairman, Representative Schwartz, it's a good point in that one does not have to be at 100% in order to be sound and safe. That calculation, just so the folks are listening from home, is the actuaries are pretty good at estimating the future liabilities out for each person, mortality, and who's going to likely to become vested and all that stuff. And they discount that back to, present value, and you compare that to the value of your assets. And you do that 2 ways, market value of assets and then the smooth 5-year. That's what that calculation is. So do you need to be at 100%? The actuaries would say yes. Yes, it's an aspirational goal and you don't need to get to it right away, but eventually, yes, that should be the goal of any pension system. It probably is a matter of judgment as to how fast. It has certainly been true that, as Senator Hicks suggested, we've been stuck in the mid-70s for a decade or more. Some of that's due to reduced assumptions, more realistic assumptions, and that's okay. But you're still where you're at. And those realistic assumptions have been kind of necessitated. You needed to do that because the investment markets have been the way they've been. So that's not just a gratuitous moving of the goalpost. It was necessitated and indicated by the facts. And so here we are. We have an obligation. The other thing that weighs upon this particular system, the way we're structured, is I believe this committee is aware that we don't make any cost of living allowances or adjustments to the pensions once people retire. And we can't even recommend that to you until we reach 100% funding with a margin of market experience on top of that. And so the achievement of 100% has another component in our state because we can't adjust those retiree pensions to account for inflation until we hit 100%. And that's been an increasing burden on folks that have been retired for 10 or 20 years, particularly now that inflation has surged more than it had in the previous years. But you're right, you don't need to be 100%. It can be somewhat of an aspirational goal, but there are these other issues.
So, Mr. Chairman, and I tend to agree, the aspiration would be to get there in 20 years instead of 30. And that's what basically it does, is it changes the trajectory. But when you look at all the circumstances that we face today, $31 trillion in federal debt, the most volatile industry, we've been told by our fiscal staff over and over and over again, we have the most volatile stream of income that the state of Wyoming has ever had. It just bounces like a yo-yo. We also know that there's a transition away from hydrocarbons, which is going to have big implications down the road. So the taxpayers of the state of Wyoming have a $2 billion liability, and I think it would behoove us to try to change that trajectory, to try to get something a little more realistic than stuck in the last, where we've been for a decade of not moving the needle towards a direction of 100%, an aspirational goal of 100% funded. But, it's up to the committee. I just think, sometimes we lose focus on what our long-term liabilities are from the state of Wyoming. And I think it's something that we should not lose focus on, because we have been stuck for a decade about where we're at today.
Yeah, so Mr. Co-Chair, I would agree with that. I think it's behooves us, particularly the CAP Finance Committee, to constantly review and take action to build up and reduce that liability. And how we do it, there are different ways. And we've been doing that really in one fashion or another over the last 10 years. And it's by increasing benefits and requiring more input from us and more input from the employer and the employee as well. And because that's really the only way to do it. And every time we have a modified assumption, then we're one step forward, two steps back. And I think we all realistically know that that dance is going to continue. And so the more that we can create a soft landing and find it, if we happen to have additional dollars, it's one of the places that it should go to address that ongoing issue.
So, Mr. Chairman, I believe there was two bills that we had 2 years ago. One of them was looking at additional contribution of both the employer and the employee, and the other one was to change the discount factor, which mirrored more what we currently have with Social Security. We actually have a program that's a little more lucrative under our discount factor for early retirements. But what I would ask is that WRS go back and look at those, try to give us some updated projections at our next meeting, and then staff would work on those two bills that we had to look at those two components, both the increased contributions and also the change in the discount factor for early retirement, and may give us some ideas on which one or how those would work together to try to start to move the needle.
Well, we probably ought to.
Good, Mr. Vice Chair.
Well, probably ought to penalize people for early retirement, because we want them to stay in there and continue to feed the fund.
Mr. Chairman, Senator Hicks, Representative Nicholas, it's interesting on the early retirement incentive. Right now, what we're talking about is all plans have a minimum retirement age, but there's a normal retirement age. And if you retire somewhere in between those, yes, you can retire because you've achieved minimum, but it's a 5% per year haircut on your benefit for retiring. If you're in tier 2, you need to be in normal age is 65. If you retire at age 64, you get a 5% haircut, 63, 10% haircut, and so on. That 5% number is actually contained in a budget footnote that still has legal effect. I think it goes back to session laws of 1990 or 1994. Ben Brandis, our general counsel, could correct me. It goes back a long time. The statute says that the board sets that rate, but the budget footnote overrules the statute. The actuaries would say that you should probably have an early retirement factor more equivalent to your actuarially assumed rate of return, which currently is 6.8%. And so in their mind, maybe the board should raise, the 5, or the legislature should go to 6.8, or just return the power to the board, let them do it. And that's probably what they would do. But there's different philosophies on that. Exactly was expressed. There was a period of time where we were looking at early retirement incentives. We kind of wanted people to go. And now we're trying to hold people. So that's kind of a yo-yo that goes back and forth. The existing thing is modestly, say, incentivizing for early retirement, but it's pretty modest. And there's other systems out there. In Idaho, it's 5% per year from age 55 to age 60, but from age 60 to age 65, it's only a 3% haircut. So they just depended on and that has little to do with actuarial. It's part of plan design and how they want to manage their workforce. And that's another aspect to that. It doesn't tend to have a whole lot of impact. There's not many people, actually retire that early, but it has some. And the law enforcement plan, the board just took a big laydown at our meeting in Hewlett on that, because we know that's the one plan that certainly needs a rate increase. With the new assumptions, it climbs a little bit from its current level of 86%. It gets to the 90s and then it stagnates. It never gets to 100%. And so we know a rate increase or a benefit adjustment is indicated, and we asked the actuaries to do a full laydown of some possibilities, and then we would go to the stakeholders over the next year. What do the employers think about this? And we would have something for the next budget session in 2024. But it's probably going to be at least a 3% rate increase, maybe 4%. If you just do it just with rates, it's probably 5%. But there are some things that you could do with normal retirement age in that plan. And one of the aspects, was change the 5% to 6.8.
So, Mr. Chairman, just a real quick question. Does Social Security, what do they use? Isn't it 7% discount rate on Social Security?
It's about 7%. The way Social Security works, you have a full retirement age, which these days for most people approaching age, I'm a 66 and a, used to be 65. I'm a 66 and a half person. And it's going to be 67. If you retire a year earlier than that, it's about a 7% haircut. And if you retire a year later than that, it's actually a 7% hair growth. Yes, I'm not sure of the right term, but it's just a median point, but it's about a 7%. That's right.
All right. So, Mr. Chairman, I've got one more question, and I'm glad the state treasurer is still here. I'm just wondering, when we look at the different consultants between what RVK does for the state treasurer's office and making some of these reviews of performance compensation and stuff, and then is it Makita that you guys use, and just is there a comparable between those two? So are we using apples for oranges, or are comparable between these consultant firms or not?
I think I'm going to ask Sam to comment on the consultants and the different consultants that are out there.
And are you specifically asking about their reporting as it relates to performance compensation?
Yes.
Okay. So there are a lot of similarities between the two programs. One of the biggest differences is a bit philosophical in that our board's decided that our performance comp should only be based on the total portfolio. So if one SIO, senior investment officer, is performing really well and his asset class is outperforming and another one is underperforming, if we beat the benchmark, they all get paid the same. The pro of that is that bonuses are never paid if the total portfolio is underperforming. The downside is sometimes it's not as fair between senior investment officers. And the Treasury's taking the approach of paying half based on total portfolio, but the other half based on asset class to try to make up for that difference. But our performance comp is based on our performance book of record. So it's calculated by Makita, and they reconcile with Northern Trust, and there are no adjustments. So I think that Treasury excludes some legacy investments that weren't as applicable, but for ours, it's just our performance report with no adjustments.
And Mr. Chairman and Senator Hicks, I'd add with regard to consultants, RVK is a fine firm. We actually use them in a different role. They're the advisor on our 457 plan, and Bo Burgraff from RVK regularly comes in and briefs the board on how that program's working. The board selected Makita out of a competitive process. We used to be with New England Pension Consultants, and all the consultants, have the same access to similar data. Sometimes their databases are just a little different, and they express things a little different. In my experience, sometimes it isn't so much the firm, it's the consultants you have. They happen to work for RVK, but they move around a little bit. Sometimes it has more to do with the actual personalities of the consultants that are assigned to your case than it does the actual firm, because they all have access to pretty similar peer sets. And that's a lot of what you're asking them to do is, what does the landscape look like out there? Well, they have the knowledge and the ability to do that.
Thank you, Senator Hicks, Mr. Chairman. I guess if I was going to redo our plan, I think I would probably use a base just like the retirement system, as far as the base for, like, say, 50% of the plan. And then I would look at ADIA and I would look at South Dakota, because they have a kind of a proportional plan as you go up, and you have performance that's above the expected, beating your benchmark. If you do better than that, then essentially you're incentivized to do better than that. But you have to be careful, because you don't want to have people incentivized to take too much risk. But we've got a risk cap, in our plan, and the board caps the risk, I think, for pretty much for the retirement system. So I think that we can alleviate that potential negative thing. But ADIA basically uses peers on all of those. I think that I'm not sure the details on South Dakota, but the way ADIA works is that, and this is for everything, there's no base. It's like you have to get to the median of your peer group before you're even eligible for a performance pay. And then if you're the very top person, very top person in the peer group, then you get 100% of your performance pay. But it's proportional through that whole thing. But you have to meet that baseline of a median. And so our problem is that we don't have good comparators. The retirement system has a lot better comparator system, as far as, if we were going to look at increasing the performance pay package or something and doing it on a merit-based system. I think there's a couple of good examples out there where I think you could do that.
Okay. Go ahead.
Just going to your report, you talked about the Montana Board of Investments as an anecdotal scenario of one of their beginning analysts' base pay is 80 to 100,000. I'm just curious, tell us how you compare to the Montana Board of Investments, and do they have performance compensation in addition to that?
I'm not familiar with if they have performance comp or not. I'll have to get back to you on that, Representative. The qualifications they were citing were for pretty similar to what we have for our analysts. It is a combined investment board. They manage assets. I'm thinking they're about a $15 billion operation, mostly with retirement. They manage the teacher retirement and the public. They have two retirement systems in that state, but one combined investment board. They're just a little different. So I think assets are about 15 billion. I don't know about incentive comp.
I don't know, but I could contact that CIO. And I think it's interesting to note, even if we're paying an analyst $60,000, even if they get their full performance comp, that only brings them to 75. So they would be less than the salary for Montana right there. And then there's vesting as well. So it'll be a while before they'd receive that too.
And so when we meet as the subcommittee, I think we're going to want to have comments on the 25, 50, 75%, because those numbers have never they were pretty arbitrary when we came up with them. And I don't know if they really make sense. And so if you have commentary on it, or what other folks do at the different levels, I think that would be useful information.
Yeah, Mr. Chairman, Representative Nicholas, I appreciate that. I think in our internal discussions, it's that 25% for the analyst that's a little low, because their base pay is already low. And as Tom Chapman expressed to you, And sometimes that's okay. They don't have as much control. You're trying to compensate for the influence and control and hence responsibility. But it does make us, even with a full measure of performance comp, our analyst pay is not very competitive compared to, the folks up north, at least in this one case. And we've also found through experience, this is a little bit of trial and error, that the analysts are really important to the operation. And although you're just necessarily going to have a little more turnover there because they're young people, right? They're newer in their career. They may leave you for a different type of work. They may leave you for family reasons. They may leave for love. The girlfriend's in Oregon. Stuff just happens. They're young people, of course they are. But still, you want to minimize the turnover and not be in a position where they leave because of compensation. And the analysts have been really important. I told the governor's staff a quick story, and I know we're pushing time here pretty quick. But I call it the Delta Airline story because it's easy to understand. And this is a case of after the pandemic, Delta Airlines, it's May of 2020, and they were going to sell off about 20 of their best jets because they needed to raise cash. And they would sell the jets and then lease them back. So I'll sell you the asset, and then I'll become a renter for these 20 jet planes. And there was a financial consortium developed to buy the planes. And because you could get the rental income was going to be pretty good and pretty steady. And Delta was one of the strongest of the U.S. carriers, no real risk of the company going away. But they needed to raise some cash. And so we found out about it through our fund of ones. Hamilton Lane brought the recommendation to us. It was analyzed by our analysts who brought it to senior. But it was we were going to get a small sliver of this deal. We were going to get about $10 million is all we could get. It was the analysts that said, this is a pretty good deal. Let's see if we can get more. And they worked the phones over the period of 3 days. This was a really short time frame. And they got us up to $15 million. And in the end, so we invested $15 million into this deal and got our rental income. A year later, another firm wanted to buy out the whole shooting match, and they bought us out at a premium. We sold our $15 million position for $29 million. We basically doubled our money in a year. And because we had an additional $5 million in the deal, that additional $5 million was in itself worth another profit of $5 million. And that was done because we had analysts on the staff that could devote the time and energy to do it. If we had just gotten the plain vanilla deal and didn't have the adequate staff and didn't have the smart analysts on staff, I think we would have been in for 10. I think we would have still participated, but we probably wouldn't have done for 15, and that would have cost us $5 million. $5 million will pay all this stuff for years and years. And that's just one brief example of what a trained, competent, energetic, young analyst can do for you. The leverage is huge. Anyway, it's a good story.
Okay.
That's more work, right? Yeah, Mr. Chairman, Representative Nicholas, you raised a good point about the analysts, and virtually all the analysts we've hired have come from the university, and typically we're getting the best students, 4.0 students, really smart, hardworking, good kids who want to stay in Wyoming. It's always a shame if we train them for a year or two and they're really productive, and then all of a sudden they're going to a different state because the other state's paying them $10,000 or $15,000 more. So that's something we really want to avoid. We want to prevent that brain drain and keep them here.
Yeah, so in summary, as we look at our program, and we'll work with the subcommittee, that's a really good idea. Yeah, we're kind of concerned about the analyst base and the analyst participation and the rate in the incentive comp. And that's where I think some of our comments would focus. Maybe that 25% should be higher.
Okay. Look forward to having our working group work on that and come back with some recommendations and see what we can do to get this continue to work on this and improve it for both the Treasurer's Office and retirement system.
Mr. Chairman, I'd like to offer, if I could, any concluding remarks from my board chair who's on the Zoom.
Sure.
Mr. Chapman, do you have anything to add?
Go ahead, Tom.
Yeah, my concluding remarks is I don't have any. So
Thank you for that, Tom. Good to see you.
thank you.
So we're, I think, just a hair of it. Are you ready for your morning break? Okay, I'm getting that, I'm getting some of those looks. So we'll take a quick morning break and be back and take up with, I think workflow automation's next, isn't it? So we'll come back and we'll start again here in about 10:20.
Real quick. WRS home committees. What's that? Which committee you guys can be? I don't give a shit. It's almost identical.
Thought you were gonna come over for dinner last night.
I didn't get here till shit.
Oh, really?
Yeah, do you have a big dinner?
We had buffalo shish kebabs, delicious.
No, I got here middle of the night.
We had an all Wyoming dinner. Bags of grown vegetables and Teton County produced bison.
Wild bison or tame bison?
Wow.
Okay.
We'll go ahead and call ourselves back to order. Next item on our agenda, I believe, is some Treasurer's Office updates on the workflow automation. So I've got, hi, Dawn, how are you today? Madam Deputy Treasurer.
Good morning, Mr. Chairman and committee. My name is Dawn Williams, and I am the Deputy State Treasurer. Since we last met in July, we've gone online with and have been using our new order management system as of August 15th. We conducted the Treasurer's Annual Conference at the end of August, where we saw some of you and missed the rest. By all accounts, the content was relevant, the networking was on point, and the food was tasty. We have secured our spot in Jackson at the Jackson Lake Lodge for next year, so we hope to see more of you there. We're still hunting for the perfect folks to fill our positions in the office and have conducted 11 interviews in the last month. I am happy to say they paid off, and we've selected some fantastic candidates for our legal assistant and accounting manager positions, and recently another principal accountant. We received her letter this morning of acceptance, so that's very exciting. We have one more principal accountant, a senior investment officer for private equity, and the attorney position to fill. We did contract with our previous attorney to assist us with investment contracts while we search for her replacement. And we're still waiting on A&I to properly classify the COO position authorized by the legislature during the session. Our original request went over to the HR division at A&I on June 21st. However, we've continued to follow up, but we have received no response as of this time. In the meantime, we have issued an RFP.
From HR?
Correct, okay. Mr. Chairman.
Walk us through that. I mean, conversations with A&I, timeframes, deadlines.
Ecosystem services are all around us. Clean water, clean.
Can you shut up?
Clean water.
I'm sorry, Mr. Chairman.
When they're going to get back to you?
Mr. Chairman, Mr. Co-Chairman, when we inquire, I inquire about every couple of weeks. Oh, we're working on it Tuesday. In fact, during the investment conference, the annual conference, I had testified to you folks there that they were meeting with the classification department was meeting with the A&I division administrator on that Tuesday that we were in Saratoga. So when I got back, I said, hey, how's it going? Oh yeah, we're still working on it, it's on our list. So every 2 weeks I follow up, and that's the response, that they're still working on it.
How long does that usually take?
Mr. Chairman, this has taken a very long time. I think that the agency struggles. I've heard them testify before in previous years when in my former role as your support staff for the Joint Appropriations Committee, that I think that they haven't said this, I'm not speaking for them, but I recall that they have testified previously that their feeling is that it is the job of the legislature to appropriate funds, and theirs is, the executive branch is to determine how the funds are utilized. So when the legislature says you will, here is a position and you will pay it this much, they struggle with that to fit that directive into their process for classification and compensation. And I believe that that might be part of the struggle for this position.
So Don, if you would, why don't you put together a letter from Drew and I to A&I asking for an update and a timeline, and then have them available to testify in October if it's not resolved when we next meet.
I think that's a request to DON, Don, and not DAW.
Right,
Okay.
DON, Don.
Okay.
And I presume Trish is listening, and if you are, Trish, please just shoot us an email, and so we can just understand this better, so we can get it done. All right, thanks.
Thanks.
Very good, thank you.
Mr. Chairman,
Sure, go ahead.
before we
Mr.
get too far along, Don, you mentioned that the Treasurers Conference would be next year in Jackson. Is that gonna, like historically, we've done piggyback after the Federal Reserve's conference, or same time frame, or different time of the year? What are we looking at, trying to piggyback off of that?
Mr. Chairman, Senator Hicks, that is absolutely what we're trying to do. That has been that's what we did in 2019, and then of course, you know how that went after in 2020, but that's our intention, is to get back there for the same time frame and for the same purpose.
Yeah, I just thought that was excellent, being able to keep some of those folks over for the, we had
Don,
Kansas City Federal Reserve and a number of individuals there.
in that regard, I think that there's a high likelihood we're going to need Senator Perkins as a presenter at that event.
Mr. Chairman, so noted.
If I can just get a bathroom pass, it'll be all right.
So, Mr. Chairman, where I left off, we have issued an RFP for a headhunter. We got some feedback from the Investment Funds Committee that this is an important enough position that they would like the option to be able to utilize a recruitment firm. So we did put out an RFP for that, and we are in the middle of waiting for responses from folks before we consider those. My comments, hopefully by the time we get our RFP contract awarded, we'll actually have a position for which they can recruit. So I am pleased also to tell you that we are on track and on time with our audit submissions to both SAO and to MHP, our external auditors. As for our accounting system, it is functioning as we hoped, and the reports we're generating are incredibly helpful already. Jeanette Beeman, who is our master planner and expert in systems, is working with Broadridge to finalize our phase 2 milestones right now. We will dive back into phase 2 after the audit submissions are final in November. That is our priority, and we had planned for this timing because we knew that was going to be a challenge for us to do both.
So how are you, how's that looking so far? I mean, year's over, MHP is probably, have you got them scheduled in, and how's that looking for this year compared to last year?
Mr. Chairman, we are looking much better this year than last year. We are, I think the build out of our staff has, as predicted, been very helpful to us in being able to spread the work around. We've been cross-training. If you come into our office, you'll see on several days of the week, we have multiple people in cubicles because they're learning from each other. And so I think that's all coming to fruition. Like I say, we've met all of our deadlines and we're on track to meet the ones. We have our next deadline is October 3rd. The biggest one is October 17th. We were advised by the state auditor's office that if we could not meet our October 17th deadline, we'd have to look at revising the due date for the audit and just call it earlier than we did last year. And I'm pleased to say that we have been communicating with RBK, our consultant. What normally causes the delay is that reporting of the alternative investments, as we've discussed in previous meetings. And so we have been very clear with RBK about our deadlines and our need for that information as timely as they can possibly get it to us. So we are already working with those managers, pushing, prodding, encouraging them to be able to report the information to RBK, who can then generate what we need for the statewide audit. So we feel good about that right now. We feel like we are going to make our deadlines.
Well, and theoretically, those deadlines ought to be incorporated into your contracts with your managers so that they have to do it or they're penalized for it.
Yes, Mr. Chairman, that's correct.
So, Don, update us again about, if we transition to more of a fund of one concept, there was discussion at our last meeting on whether or not you will be capable of handling it by July 1 of next year. Can you just tell us your thoughts on that?
Mr. Chairman, Mr. Co-Chairman, you mean the total return strategy, the fund 20? Yes, Mr. Chairman, we are able to accommodate the July 1st date with the accounting system. We built in our timeline, which is on the agenda for later today. From from stakeholder discussions all the way to parallel testing because it won't require any different programming for us, but it will require a different way of reporting the information. And so Katie is here, and she and I have worked together on a timeline about how we would make that transition so that we would be able to make the July 1st deadline. And, you know, we are very sensitive to our ability to make promises to you about deadlines. And so we feel like we've thoroughly vetted that to be able to say to you that, yes, that is a feasible timeline for us.
Thank you. Continue.
Let's see. I just have one closing thought. The office has faced a lot of challenges over the last several years and most assuredly will continue to do so. But it's nice for me to be able to come to you with good news today. Thank you, Mr. Chairman.
And we're glad you're able to come with us good news today, so thank you. Any other questions for Don this morning?
Yeah.
Yeah, we'll do the happy dance if you want, it's okay.
Yeah.
All right, thank you, Don,
Thank you, Mr.
appreciate
Chair.
it.
Committee.
So I think that puts us on to, I think we've got some, I think next is for proposed legislation. So Brian and Matt. This is 0155 version 0.5.
Yep, that's correct, Mr. Chairman. It's 3-01 on the online materials. Mr. Chairman, members of the committee, this bill draft amends provisions related to the Investment Funds Committee's selection panel to require the election of a chairman and to specify deadlines for filling vacancies of both IFC members and selection panel members. This bill draft, which was requested at the last meeting, is based on recommendations from the State Treasurer's Office. Walking through the bill quickly, page 2, lines 10 and 11, this is an amendment to 94720C, and just specifies that the selection panel must, within 60 days after an IFC position becomes vacant, appoint a new IFC member to fill the remainder of that unexpired term. Then moving on to page.
So just out of curiosity, what happens if you don't? What happens if they don't meet the 60-day requirement?
Mr. Chairman, the bill doesn't specify any penalty or consequence.
Okay. Well, I thought maybe there should be a plan B. I don't know. We'll see. All right, go ahead.
Mr. Chairman, it's aspirational.
Aspirational. It's our new word today, aspirational.
I thought that was exasperational.
Exasperational, yeah.
So
okay.
we had, we talked about this, I think, at the Treasurers Conference, and the discussion was basically moving the 60 to 45 days in order to get this thing, to get it done. And so I'm just curious on if, we want to get it done as quick as we can, but we need enough time to get it, to be realistic about it. So why 45 versus 60? How did we, originally I think it was 30 in the first draft that came out. Any comments on that, or Mr. Treasurer?
I think the 60 probably came about as to the amount of time that the Secretary of State took to do their appointments. I think he went through several different candidates. And I think that one of the things that would be appropriate for us to do is to develop a pool of candidates through our office and the IFC. So when these openings come up, then if somebody doesn't have somebody that they could pick, but he tried, I don't know how many times, 3 times, Matt, I think it was like 3 times, and it just, there's a problem with each candidate that, first of all, they looked at it, no, I don't have the time, no, I can't do it. Some of them were unqualified, basically, in some way or another, and couldn't do it. So it took a while. So I think, and we can do that without legislation, that's something that if you guys want to put it in, then that's fine. But I think that we can make sure that there's a pool there for people to pick.
And I would concur with that. And not only that, but if we have good communications with the IFC members, and we know when they intend to, or if they will give a reasonable notice, yeah. So that you can do most of the work before they even leave.
Right.
And so
the
if
selection
we do it
committee
right.
Yeah,
then-
and the selection committee members too. So I think that's, you know, we can do a survey at least once a year, you know, as far as that goes with the selection committee members and asking them whether or not they you know, want to continue or should, you know.
Yeah, okay, thank you.
So, but before we leave that, so is that you, Lloyd? So before we leave that, Mr. Treasurer, so I mean, coming back to it, I mean, what I thought I heard you say was 60 days was kind of the number that it took the Secretary of State in the last one. That's where you picked that. I mean, is that, you think, I mean,
It actually took more than that. You know, I think it took him months to finally get something done. And the problem was when it was made aware that the committee member there wasn't really what I'd say any kind of a timeline, you know, and it was hard to push somebody into the emergency situation that actually was starting to occur. So I think the 60 days is short enough. You know, could it be shorter? Could it be 45? Yeah, probably if we had a pool of candidates that were readily available, I think it could be 45. Is it necessary to be 45? Probably not, because we don't have people appointing, you know, to the
Mr.
IFC
Co-Chair,
that often.
What I would suggest is that have your office put together a policy or procedures. So you set out the events, and when we have our IFC meetings, we'll outline what those are. So if someone's going to retire or resign or whatever it is, they give sufficient notice. And then your policy immediately goes into effect, working backwards from when that date is, to make sure that the pool is updated and they get the comments. And so basically we prevent that from happening again, because it's a good question. Just because we put 60 days doesn't mean 60 days are going to happen. I think that part of the problem is it just kind of fell through the cracks, and there wasn't a policy or procedure on what you do when that situation happened. And if you have that policy or procedure in place, which you can do without, you know, by informal rules or however you want to do it, then we'll get there. And because the quicker the turnover is filled, it's better for the position, it's better for the IFC, and it's just more professional. So, but it'd just be, I think, a useful thing to do. So.
Well, Representative Larson. Okay, thanks.
Mr. Chairman, maybe a
Go ahead,
little
Matt.
color on that what happened in the past. These were two new positions, so we've never actually had an IFC member leave the IFC yet. These were two new positions. It was a bit of a perfect storm with regard to one member, which we can get to later in the bill, you know, applied to be an IFC member. And another member the day before we were supposed to meet as a selection panel resigned his position, and that was the Secretary of State's position. The Secretary of State did have some difficulties, you know, finding a replacement, and I want to say it was 4 to 5 months, maybe 4 months. Regardless, a fairly long time. This 60 days would at least give us a little teeth to talk to the electeds and say, can you know, try to get this done as quickly as possible. The original language in the bill was 30. I think the concern would be, and which could be alleviated with the treasurer's idea of a pool of candidates, but in this bill, there's 60 days to replace an IFC member and 60 days to replace a selection panel member. I think a pool of candidates would help filling those positions faster, which we have now gotten a larger pool of candidates that we've met and discussed with. So several of them, when I talked to them to let them know that had been filled, they were all interested in becoming an IFC member later if the opportunity arose. So I think that would help alleviate. Is there a big difference between 60 and 45? I don't know.
Yeah.
We were comfortable with 60.
Okay, thanks. Go ahead.
So just so I'm sure I understand, the selection panel only has one task. So it's, if there are no vacancies on the IFC, they don't meet.
Mr. Chairman, Representative Swartz, correct. The members do serve 3-year terms, so there's generally an appointment. So we do meet generally every fall, but if there's not new positions, it's generally a much shorter process.
Okay. All right, continue on.
Yep. Mr. Chairman, moving on to page 3, then this is an amendment to 94721A that just provides that a selection panel member must be selected within 60 days of either a vacancy on the selection panel or a new member of SLIB who would be responsible for appointing a selection panel member. The staff comment on page 3 just notes that any vacancy in a state office that would be a member of SLIB must be filled within 20 days. And then except for the office of governor, there's a list that specifies who assumes those duties. That's just informational only. Then page 3, lines 28 and 29, the selection panel must elect a chairman from among its members. And then on page 4, lines 5 through 9, just inserts a sentence that provides that a member of the selection panel who seeks nomination or wishes to apply for the IFC must resign from the selection panel first. With that, Mr. Chairman, I'll stand for questions.
And just on, so going back on to on page 3, the new language on page 3, and then in conjunction with the staff comment, that just is that part of that is that anybody else except for the governor gets appointed within 20 days. So 60 days, it still seems like that's within a reasonable time. But with respect to the governor, where the Secretary of State would assume those duties, so then the Secretary, the way it's written now, that's why it's written that way, is in light of the staff comment. Is that the relationship that we're supposed to pick up there?
Yeah, Mr. Chairman, if there's a temporary appointment, that must be filled within 20 days, after which point, there'd be 40 for that person to pick their selection panel member.
Yep. Okay. All right, any other questions? Other comments? Okay, is there anybody else who wishes to speak on this bill draft? Anybody else to speak on this bill draft? Is there anybody online? Okay.
No, sir.
Move the bill.
Oh, that's your pleasure. The bill's been moved. We got a second. Got a second from Representative Larson. Any discussion or amendments? Discussion or amendments at this point? There being none, the question has been called. We'll go ahead and I guess we'll call the roll.
Thank you. On 23 LSO 0155, Senator Driscoll.
Aye.
Senator Guru.
Aye.
Senator Hicks.
Aye.
Senator Kinski excused? Yes. Mr. Chairman?
Yeah.
Senator Kinski is excused, as is Senator Nethercott, correct? Thank you. Yes. Representative Hallinan?
Aye.
Representative Harshman? You're muted. If you want to give us a thumbs up, thumbs down.
Aye.
Thank you, sir. Representative Larson?
Aye.
Representative Obermueller? Aye. Representative Schwartz? Aye. Vice Chairman Nicholas? Aye. Chairman Perkins?
Aye.
You have 10 aye, 2 excused.
Okay.
Will this be House or Senate?
It's your pleasure.
Thank you, sir.
Okay, Senate. Senate it is. Give you a warm up.
We don't have to play softball.
All right. So next, I think that anything else takes that, or the next one is cash-based budgeting is what I believe we're ready for. Hello, Dawn.
Good morning, Mr. Chairman, members of the committee. My name is Don Richards. I'm the LSO Budget Fiscal Administrator for the record, and I'm referring to attachments 4, 1, 2, and 3 in the committee's agenda. At the July 26th meeting of your committee, you had requested additional information regarding cash-based budgeting, additional analysis, and some alternative approaches to cash-based budgeting or hybrid approaches. I would refer to that memo from July 26th meeting, which defined cash-based budgeting really in two different ways. We have the one option where you're basically limiting the size of your budget by the amount of cash on hand. And then another alternative would look at actual cash-based expenditures. By way of background, Wyoming Statute 92-1013 and surrounding statutes provide the framework for the governor's submission of both the budget development as well as the supplemental budget development. Those statutes can be found in the appendix to my memo. Those provisions, importantly, are not subject to, or the legislature is not subject to those same provisions. So for example, there is the 5% statutory reserve amount that must be provided for in the budget reserve account. That is a requirement of the governor. There is no such requirement on the legislature. Before moving into the figures, I also wanted to touch base on the timeline, just so that's familiar with everyone. Craig meets in January preceding a budget session, which is about 6 months prior to the commencement of a biennium. Biennium commences on July 1. And then throughout the 24-month biennium, after that, there is an accrual period for revenues that come in later. That can be investment income, sales and use tax, severance taxes, federal minimum royalties, all subject to accrual accounting. That typically adds about 3 months. So when we're thinking about what does Craig forecast for a typical budget, if you add up all that timeline, it's about 33 months. 6 months before the biennium starts, 24 months during the biennium, and then those 3 accrual months, which adds up to 33 months. We're just finishing up, in fact, this week, the accrual amount for the FY 21-22 biennium. That forecast was made in January of 2020. A lot has happened since January in 2020. I just wanted to kind of set the stage there for the fact that in Figure 1, we provide the Craig estimate, which is in a blue dotted line, actual revenues, which are in a green line. The red line reflects the initial budget that was adopted by the legislature in its budget session, whereas the pink line, and it's further designated by a triangle dot mark, that would reflect the supplemental budget. And then the black line at the bottom is the cash balance of the LSRA as a proxy for the primary rainy day fund for the legislature.
Mr. Chairman.
Yes, go ahead.
Thank you, Mr. Chairman. Don, could you just explain the difference? Because we're talking about cash-based, could you just explain, you used the word accrual, how accrual relates to cash basis and the difference between the two? Thank you.
Sure, Mr. Chairman, for our purposes, revenues that are earned in the biennium are counted as part of the revenue of that biennium, regardless of when the cash is actually received by the state. So as an easy example, if a constituent of yours goes down to a local big box store and buys a lawnmower toward the end of June, they pay sales tax to one of those big box stores at the end of June. That store may remit that to the state in August or even September through its normal processes. And once the state receives that cash on hand, it's actually retroactive to the balance of the prior biennium to reflect that the transaction occurred in June of 2022, not when the state received its cash, which might be 1, 2, or as much as 3 months later.
So going back and on that thought, just bringing it We get our federal mineral royalties are dispersed quarterly.
Mr. Chairman, I believe they are dispersed on a monthly basis.
On a monthly basis. And so, for example, so it's possible that in the cash-based budgeting, that you might not, at least 1 month and maybe 2 months at the end of the fiscal year might not be received as of the end of the fiscal year. So even though we would count those under the current system as monies earned in that biennium, and the cash-based budgeting system, those would not be considered available, or they would not be part of the cash budget. Is that, do I understand what you're saying?
Mr. Chairman, that is correct. I should make a additional note, which was included in that July memo. When we're talking about cash-based budgeting, that doesn't, and if SAO, the State Auditor's Office, is listening in, a component of that is not a recommendation, at least in the prior legislation, to change the state's accounting to a cash-based accounting. So the accounting would still be accrual, and the budget would be based upon available cash on hand.
Right, and so every year you would have to make adjustments because we have, so you have federal mineral royalties, you have sales tax collections, you have property tax collections. We're going to the, as we've moved from on severance tax or ad valorem tax collections, now you'll have 1 or 2 months, potentially 3 months at the end of a year, are not in, but 3 months from the previous year, those would have come in at the beginning of the year, those will be in. So those types of adjustments are, we'd see lots of those. Anyway.
Yes, exactly, Mr. Chairman. Representative, did I answer? So referring back to figure 1, you can see that the reason we put this in here, I think the committee asked for about 4 to 6 years, but we were able relatively easy to go about two dozen years, 24 years of history there to show how Craig has performed. A couple of notes on that. You will see the red and pink lines are in excess of the blue line. And several of your colleagues have raised the question, how is that possible? How did the legislature spend more money than was forecast by Craig? And there's a real easy answer to that, and that is the excesses from the prior biennium are available for expenditure as well. So we talked about this at the Joint Appropriations Committee 2 weeks ago in Casper, and I'm fairly confident we will have over $300 million transferred in excess of our forecast to the LSRA in the coming weeks. That money in prior years, especially back in 03, 05, 07, was used and added to the budget for the successive biennium.
And capital gains could also play a role in that as well, correct? Because you don't forecast capital gains.
Absolutely, absolutely, Mr. Chairman.
Go ahead, Representative Larson.
To your point, I assume the capital gains was included in that. Is that correct, or would that be a separate grouping than what you was just referring to?
Mr. Chairman, Representative Larson, they are included in that because Craig does not forecast capital gains, so any gains we receive are by definition in excess of the forecast.
Okay. Thank you.
You can also see that Craig has more often, and you will see more specifically in figure 2, but more often than not, we miss to the low side. We do not do that intentionally, but I think I have testified to JAC several times. We try to hit the mark, and if we miss, we try to miss on the low side. Moving ahead to the options that were requested by the committee, the first option is continue the status quo, which is continuing with the existing Craig forecast process. Over the past 22 years, the Craig forecast has indeed been shown to be imperfect. It is, after all, a forecast. Nonetheless, as I referred to in my July 26th remarks, we have looked internally at other statistical methods of forecasting, and that the Craig forecast does perform favorably when looked at compared to a naive forecast, which is what had happened last year or what happened the last 2 years, and continuing those forward. Naive forecast with drift, which is looking back a couple of years and incorporating some method of momentum. Are we moving upward or downward in our total revenue collections? Looked at an exponential smoothing model as well as a REMA model, which is an autoregressive integrated moving average model. In other words, we looked at increasingly sophisticated statistical approaches, and none of them beat the Craig forecast looking backwards. So something that Craig is doing is adding a little bit of value here. It's not just running an Excel model where there's something about our discussions that are looking forward and adding value to the forecasts.
Go ahead, Representative Schwartz.
Thank you, Mr. Chairman. So hypothetically, if we went to cash-based budgeting, would you foresee the Craig still performing the same functions it does now?
Mr. Chairman, I think there would still be an opportunity to continue to use Craig for the out years. Even though the budget would not be based upon cash on hand, I would anticipate that policymakers would be interested in what the expectation is for 3 to 4 years out, 5 to 6 years out.
Thank you. That was my hope.
Also of some interest is in figure 2. Don't take pride in this. You can clearly see that Craig has missed the green line. So in the dark blue dotted line is our Craig forecast for the budget session. We've modified that with the dotted light blue line, which is the Craig forecast preceding the supplemental budget. And you can see when revenue is rising. And if you'll think back to the period 2004 through 2008, we had pretty remarkable increases over those 4 years. State revenues to the essentially more than doubled. And you can see there that Craig at the time was arguably somewhat reluctant to anticipate that trend line would continue. Now that we are in more of a flat to declining revenue, you can see Craig has been on both sides of the actual. We have overestimated, specifically in 2016, and then more recently with the COVID pandemic in 2020, our forecast exceeded.
Don, would you do us a favor and for the next Craig, double it again for us? That'd be nice.
Yeah. Do you do that by estimating low or estimating high? I'm confused. Which is the cause and effect?
Moving to the next option, if the concerns over Craig, and there are timing concerns, we clearly missed that. One option, and that is to limit the budget by prior or known revenue. And this is incorporated in not only the most recent budget or the most recent cash-based budgeting bill, House Bill 147 last year, but also prior amendments that would rely on some ratio of the prior 2 years or the prior 3 years or something like that. Well, it turns out that that approach is also imperfect, and it's in fact an imperfect substitute to Craig. It looks back and sees how revenue collected looks in the rearview mirror. It looks this approach works very well when revenues are static because it doesn't change over time, so it tends to work well. When revenues are increasing, it underperforms Craig, and you can see this in figure 3 by the purple line with the square boxes. It lagged worse than Craig in an increasing revenue environment. And then when revenues are declining, you can see in 2017-18 as a great example, it performed substantially worse than Craig on the downflow. Nonetheless, it is removing an estimate, and it is based entirely on actual revenues received. But that look in the rearview mirror does not necessarily provide a quality indication of what is to come through the windshield looking forward. Moving to the third option, and that is to limit the budget recommendations by the cash on hand. Figure 4 illustrates our budget compared against the LSRA balance. And you will come away with an obvious concern with this immediate approach, and that is there's insufficient funds in the rainy day account to fully cover a biennial budget. I did mention that far right portion of the black line, or the LSRA balance. Expect when Craig reports next month that will increase fairly dramatically, and I expect the balance will exceed $2 billion. So we will be very closer to being consistent with the biennial budget, but still a fair bit shy of that.
Go ahead.
Thank you, Mr. Chair. So my recollection, you've given us data on other states, and that our percentage of savings compared to our budget is actually near the top. Is my recollection correct?
Mr. Chairman, Representative Schwartz, it is at the top by a fairly wide margin. Most of the think tanks and associations that look at this, they look at a one-year budget, and we're 100%, sometimes 91%, sometimes 105% of a one-year budget. And for a period of time, Alaska had a similar or even higher. They unfortunately have expended a fair bit of their reserve account in the past 3 or 4 years, and so Wyoming really stands alone, and by a wide margin. So if you look at figure 4, there's maybe some insufficient funds to move immediately to cash-based budgeting on a 2-year basis. So I tossed in figure 5, which would provide cash-based budgeting on a 1-year basis. That would only require half the amount of funds. And that tends to work out fairly closely in today's environment, given the balance of the LSRA. However, it also raises some potential policy incentives, which may or may not be aligned with state expenditures. For example, I could see a situation where there would be a desire to make a deposit into the LSRA in order to grow your budget for the next year. Or refrain from making a deposit into the LSRA and rather make that deposit into SIPA or
some other new account.
Some other account,
Yeah.
Which would arguably result in a reduction of the budget through a different savings mechanism. In other words, I struggle somewhat to see necessarily the relationship between a state's needs for expenditure and the amount of savings that may or may not exist in a particular account at a point in time. Moving on to option 4, and that is 1/2 of the biennium funded with cash and 1/2 of the biennium funded with the Craig forecast. One advantage of this is Craig tends to be more accurate with its near-term forecast, the first year of the biennium as opposed to the second year of the biennium. Nonetheless, I think there are innumerable approaches that kind of take a piece from one approach, cash-based budgeting, and a piece from traditional forecasting. And that is essentially what drives me to option 5, which is a real policy choice for the legislature, and that is a variety of options. And I'll start off with the beginning. You could define the goal of the LSRA, and that's not just your legislative staff making that recommendation. When Pew looked at the state of Wyoming's revenue back in 2015 for the Joint Revenue Committee, they made a similar recommendation, or observation rather, that while the state should be lauded for having an LSRA, it was unclear what the defined goal or purpose of the LSRA is. Secondly, you could, if you so choose, define a goal of the balance of that fund, whether it should be $2 billion, $3 billion, $3.5 billion, that sort of thing. I would also note at that point that those funds can only be spent once. So for example, what I mean by that is They could either be used as cash for cash-based budgeting, or they can be used for the obligations that you're discussing this afternoon, or for transfers to move the state in a direction of a total return investment, or they could be used as a loan mechanism for the state's various account, K-12 and others, but you can only spend and invest those dollars once. A third approach that the legislature or policymakers could make is to use the LSRA and some guidance as to when funds should be deposited to that account and when funds should be withdrawn from that account. So some, preferably not in a time of crisis, but some reflection on, we have this fund as a state, and what is the appropriate time to make deposits to that, and perhaps provide some constraint or guidance to future legislatures that the overall goal is to make deposits when, Craig, or windfalls are received, or a substantial amount of capital gains are received, or Craig misses their estimate to the low side, for example. At the same time, other states have also provided guidance as to when withdrawal would be appropriate. If, for example, the current revenue stream is forecast to decline by 10% or 15%, then some guidance that a governor should look to a portion of the rainy day fund to absorb some of those reductions in current revenues. None of those are currently provided for. And then the last item is.
Go ahead, Representative Larson.
Thank you, Mr. Chairman. So Don, as I hear this option 5, and then we look in our conversation later in the day on the LSRA, and we see that when we make those commitments, or we say when, or because we've kind of done that, we said it can be used here, it can be used there, and so we put some definition in there that seems to me to perhaps put some, every time we do that, it takes a little more flexibility out of what you can do with that fund. And so if you put, say, when and how high or how low, or when it comes in and when it goes out, it takes away the flexibility that really the legislature has enjoyed with the LSRA to use it as situations arise, which isn't always predictable. Am I seeing that incorrectly?
Mr. Chairman, Representative Larson, I think you are seeing that correctly, but I also would note back on figure 1 on page 2, you can see the development of the LSRA from really zero, not too long ago, slowly building. And I think the legislature is maturing in its definition of what the purpose of the LSRA is for. And so early on in 2009, 2011, that was essentially all invested in the state agency pool. Short-term investments, fixed income, maybe cash isn't quite the right term, but pretty close to cash. And because it was invested in cash or cash equivalents or short-term fixed income, the legislature elected to use that for other beneficial purposes, wildfires, water, K-12, cash flow purposes. In the more recent years, say the last 3 to 4 years, the legislature has made a policy decision to generate higher income or higher return on the LSRA, and has invested those more aggressively in equities and alternatives, recognizing that when you do that, then you're compromising some of the obligations. So I have a couple of suggestions or comments, not suggestions, comments about alternatives that are not mentioned in the memo. For example, perhaps the LSRA, in light of this afternoon's conversation, is no longer the best account to use for cash flow purposes because it's not invested in cash. It's invested in equities and alternatives so maybe there is a desire to look at the state agency pool which is what the legislature has used in the 90s and early 2000s as your source for cash flow purposes. It doesn't have to be, or maybe there's another account out there. It does not have to be the LSRA that supports cash flow for the group health insurance or wildfires or water projects. You could pick another account. Secondly, and again, this is not mentioned in the memo, the choice of the operating cash balances of the general fund, budget reserve account, which was 5% of the general fund's revenue, and the school foundation program, which was set at 100 million and has been set at 100 million for decades, may no longer be appropriate. You may want to change those values. So for example, in the school foundation program, even in good years, we're in a decent revenue environment today. The Department of Education has a loan out for the school foundation program well in excess of $100 million today. And we're in fairly flush times today as opposed to 2 years ago, which tells me that that $100 million cash balance is insufficient to cover the cash flow of that account. And there is a structural issue there that could be avoided, meaning you could get rid of these loans that SAO and WDE and the State Treasurer's Office make simply by increasing that cash balance, say, from 100 million to, I'm not going to suggest a specific number, but hypothetically $300 million, something like that. And the same thing goes on the general fund side, where when that 5% was chosen, which I believe was 1988 or 1989, well, that was 5% of the general fund, and the general fund was the sole source of funds for the general operations of government. Well, now the general fund is about half of the source of funds for general operations, and the budget reserve account, which used to be your rainy day account, is now become checking account number 2. But there is no 5% of the BRA balance that is included for the cash balance. My point is there are modifications to the structure of the state's accounting system. If you're compelled to move towards cash budgeting, that you could make in small incremental steps by including a goal of a LSRA balance that is sufficient to fully fund this for 33 months. But there are also intermediary goals, and that is to modify the state's choice of uses of reserve accounts to more accurately reflect the cash flows that we're experiencing, as opposed to the cash flows in the 1980s and 1990s.
Go ahead, Mr. Vice President.
You know, one of the things that we're trying to do is reduce the drag on our investment returns. And so I'm intrigued by the idea that we could use the state agency pool as to use some of these cash flow guarantees for, say, this, instead of the LSRA. And some of these, have we looked at that, Dawn, as to know how much within the state agency pool that we've got there, that we still have obligations there, how much would be available that we could potentially use as just as a, I'll call it a budget balancer for cash flow purposes versus the LSRA? Do we know what that number is?
Mr. Chairman, I think it is a large number. I don't know the specific number, and I would defer to the Treasurer's Office. I undoubtedly there may be some complications, but the state agency pool has $5-6 billion in it, as opposed to the LSRA, which had $1.5 billion. And it has that amount of money consistently. Now, the prior treasurer has acknowledged, and in fact your statutes reflect this, that the investors of the state agency pool will want a return on their money. But that is already incorporated in the statutes, so that when the Department of Education or School Foundation Program takes out a loan from the LSRA, they pay the prevailing interest rate that the LSRA would have earned. So in the case of the state agency pool, you've got a bunch of entities there that are invested in that. They're going to want a commensurate rate of return, but that kind of is already incorporated in that. That $5 billion, I guess my short answer is the LSR obligations are in the hundreds of millions of dollars. I don't think we're up against a hard cap when we have $5 billion to draw from.
So, Mr. Chairman, I think it would be an interesting exercise to actually maybe have the treasurer's office go through and model what that differential would be to move those cash borrowing out of the LSRA and onto the state agency pool, and maybe go back like they did and say, had we done this 3 years ago, what would be the difference in those? I want to know what our lost opportunity cost is associated with not moving in this direction. Because it seems to me that the state agency pool is primarily invested in fixed income, lower return stuff. And then we turn around and do the same thing with the LSRA because of those obligations for the cash flow. So it's kind of like a double negative here, that if we can just shift that over onto one account instead of both accounts, may free up some opportunity within the LSRA for higher investment returns.
Okay. Thank you. Representative Schwartz.
Thank you, Mr. Chairman, and I'm headed in the same direction as Senator Hicks. So I guess my question is to make sure I understand that these recommendations have nothing to do with switching to cash-based budgeting. They have validity whether we do that or not.
Mr. Chairman, that is correct, and admittedly, maybe my direction, I broadened it a bit more, but the committee did request a range of options, so I'm providing a portfolio of options to you.
So, Don, and just following up on the Vice President's thoughts, I mean, they're kind of mirroring mine. Ultimately, if most instances, what you would have is if you were an operating business and you had, it's not uncommon to have surplus cash invested in marketable securities, but then you get caught cash short, that you would have some kind of credit facility that you could tap to get you through that time until you either liquidate securities or make other adjustments, or revenue comes in, or whatever the cash flow issue is, as a tool to do cash flow. And ultimately, whether that credit facility comes from borrowing from a third party or whether it comes from borrowing from the state agency pool, I mean, in a lot of respects, it wouldn't make much difference to the state where that comes from. But there's the opportunities that inside. I know that we so far we seem debt is a 4-letter word to the state of Wyoming as it is to anybody else, but literally, but figuratively, it's been a 4-letter word and something that we pride ourselves on not taking advantage of. But nevertheless, that's the Vice President's side, and I'm thinking about that right. Ultimately, we have that credit facility. There's nothing that says, assuming that the cash flow or the state agency pool can be met and is not impaired by that financing, you could finance out of the state agency pool and provide that credit facility through the state agency pool, and at the same time return the commensurate rate of return to the stakeholders or the owners of the funds under the state agency pools. Are we thinking about that correctly? Does that make sense?
Mr. Chairman, that's exactly how I was thinking about it. Most other states do go out externally, but there are some transaction costs associated with that, which would arguably be avoided if you moved internally, which we have for years.
All right, thanks. Anything else? All right, go ahead, continue.
Mr. Chairman, I guess just in kind of summary, Craig has certainly been imperfect in its forecast of actual revenues. We met yesterday, in fact, as our minerals subcommittee, and we are at a point, I think the Vice President mentioned this earlier today, at really unprecedented levels of volatility. In the natural gas 90-day volatility average, it is multiples outside of its traditional confidence interval. What I'm suggesting is we can expect continued volatility both to the up and the downside, and Craig will continue to serve as an imperfect estimate or forecast of actual revenues going forward. If you are compelled that some approaches are perhaps better than others in terms of using Craig to the extent possible, or relying on other limitations on budgets, limiting the governor, for example, or providing guidance to the governor on when to make deposits or withdrawals from the rainy day fund or the LSRA, or to provide additional guidance in the development of future budgets. Those are options available to the legislature. Alternatively, you could establish parameters for, or a purpose for the LSRA, establish a preferred goal for the size of the LSRA, as well as provide guidance, policy or informally, or formally through statute for the withdrawal or deposit in those accounts. I'm prepared, as the committee requested, both the introduced version of House Bill 147 from last year, as well as the engrossed version, which are quite a bit different. They are included in attachments 4.2 and 4.3 to the committee's agenda if you wanted to summarize what those did or refresh your memories.
Okay, before we launch into that, let's go ahead and pick up other questions or comments before we, yeah, go ahead, Mr. Vice President.
Okay.
You want to go to?
Don, I'm just curious with the forecasting stuff, and you had mentioned it, but nobody's going to hit the mark all the time, but what we want to do is forecast within a range. And so when you've looked back at Craig and you look at like the figure 1, the baseline of revenues forecast, are we plus or minus 5%? What is that confidence interval? And the reason I ask that, because I think that's really, I think what my expectations are is that we're going to try to fit within a range, knowing that nobody's going to forecast the actual dollar per MCF of natural gas plus the amount that we produce. And I think we've tried to accomplish this with that white rod, is give us a range, a best case, so that's the confidence interval. But looking back, when I look at this, I just don't see where, it looks to me like if we put a 5 plus or minus 5%, Craig was probably accurate within that range more times than not.
Mr. Chairman, the natural volatility of Wyoming's long-term revenue collections has been on the order of 13%, plus or minus in a particular year. So we have pretty high volatility. We were definitely outside of the plus or minus 5 or 10 during the, what I'll call the natural gas boom with the Pinedale Anticline and the Jonah. Since then, we have performed considerably better. But even in this last 2-year biennia, our January 2020 forecast turns out to be relatively close. And in May of 2020, we made a revision to Craig, which in hindsight was worse off than what we might have done if we had held it constant. In some defense of Craig, we were uncertain at that time the level of federal fiscal stimulus and the timing of that federal fiscal stimulus, and the duration of the lockdowns in our state as well as other states. But that is another area where Craig provided a zig and the economy zagged, to put it nicely.
Okay. Go ahead, before we do that, Mr. You were next, I think.
Yeah, I just wanted to follow up on some of your comments, Don, on cash balance and how we have to borrow from ourselves, particularly on the education side. So I think it'd be useful for us to see that in a just the balancing on which agencies do it, how much they need, and what's the typical payback period of that, so that when we work with this, as part of our structuring into a fund of one, I think we need to take that into consideration on how we set up and the accounts and what the reserve accounts are, so that we address that issue. I mean, we have an opportunity to do it. I think it would be a useful exercise for us to do it if we can, and what that would cost us to do. And whether that comes from LSRA or from the pools account, whatever it is, how we can do it.
Mr. Chairman, happy to do that, but I think in in the big picture, there's really one, and that is K-12. And it's fairly consistent, and it's in the hundreds of millions of dollars each year. In fact, this year, I think they were at $250 million toward the end of June. And because of accrual accounting, they're really not able to pay that June 30th balance off until somewhere around October for cash flow purposes. We can identify some other instances, but they're going to be fairly limited. And I mean, $5, $10 million instances. K-12 is by far the biggest. The rest of these are on your agenda for this afternoon. These are the LSRA options, and there are option value there. So let me just talk about one, but there's a bunch. Wyoming is one of the only states that it provides the Wyoming Department of Transportation the ability to take out a loan from other state funds in the event that Congress cannot come to a conclusion on their continuing resolution, which, by the way, they're arguing about today. So if they don't come to an agreement by Friday, in other states, their highway transportation projects shut down. In Wyoming, we've never shut down highway projects. We also, I don't believe, have ever had to access that loan, but the availability of the option of that loan has allowed them to continue their construction contracts. So even though that loan hasn't been accessed, I would be hesitant to say that it doesn't have value just by the fact that it exists.
The question is what the amount needs to be.
Chairman? Yeah. So let's go ahead and go to you, Steve. Okay, so I see Steve, but we'll go to your representative, then we'll come back to Representative Harshman.
Yeah, thank you, Mr. Chairman. So in this whole area of cash-based budgeting, sort of the framework of the argument is, we have an either-or kind of environment that's kind of laid out. We either go with projections of what's going to happen in the future, or we go with what's happened in the past. But I suspect that within the process that you deal with, and Craig, that you do take the past into consideration in coming up with these numbers. Could you address that and tell us how you think about where we've been in coming up with your projections? Thank you.
Mr. Chairman, Representative Obermiller, in many revenue streams, we are almost entirely looking backwards. And our best example is when it comes to sales and use tax, we rely on decades of quarterly information, which is all historic. And then we add some future looking, primarily oil field employment, rig counts. Those things have a remarkable impact on sales and use tax collections. And we supplement those limited forward-looking variables with our historic quarterly information. And so in that case, I would say it's tremendously based upon history. Our other revenues, which are liquor sales, cigarette sales, I would say are the same way. Where we look a little bit more forward and a little bit less in the rearview mirror is when it comes to the extractive industries. We certainly look at our historic production, but when it comes to prices, we look at investment house, energy house, and government price decks, as well as the futures markets, to look forward for our pricing variables. But that's kind of an anomaly. Many of our other revenue streams are already incorporating historic information. One more comment on that, and I really did not intend to set this up as an either or. I think there are those hybrids that would give the policymakers or the governor a indication of when to draw from rainy day funds, cash, and when to make additional deposits, or even additional restraints on recognizing the volatility and restraining some level of immediate consumption for the opportunity to have future consumption.
Don, on the, I don't know how to frame this question, so I'll hold on.
Okay, well, while you're formulating that question, we'll go to Representative Harshman.
Thank you, Mr. Chairman. Mr. Richards, just to kind of go back a little bit on that accrual issue with K-12 education and you know, it's mainly funded through ad valorem, property taxes, and then FMRs, of course, play a big part. But is that part of that issue? Just the timing, the accrual part. But then my question really, will that improve with the monthly ad valorem collections for mineral production as we kind of get fully vested and move forward with that? Thank you, Mr. Chairman.
Go ahead, Don.
Mr. Chairman, Representative Harshman, you are correct. There are two big resources for the school foundation program, investment income and FMRs, and both of them are the worst in terms of accrual, meaning they are the highest delays. For example, I think the state treasurer's office has, you know, until the end of this week or so to make the deposits into the common school land income account for its final investment income and subsequently to the transfer to the school foundation program. So it's about, you know, 90 days in arrears. Similarly, federal mineral royalties are about 60 days in arrears. And you mentioned property taxes, but the school foundation program really only receives 12 mills of those property taxes, as opposed to the local property taxes that support the local school districts. So ad valorem change to monthly has a rather muted impact on school foundation program cash flow.
Okay, thank you, Mr. Chairman. Just follow up. So that really doesn't affect then the, you know, the entitlement piece or the recapture piece then so much on that. When is that kind of fleshed out at the end of the school year? Thank you, Mr. Chairman.
Mr. Chairman, Representative Harshman, in terms of receiving the funds, I think both school districts and the state and arguably counties will get their money quicker as a result of the monthly ad valorem payments. The challenge is they have enjoyed for a century a known amount of revenue. And so the introduction of the monthly revenue actually increases volatility for those entities. And that increased volatility is probably a larger impact than the timing benefit. Now, I'm not suggesting there wasn't another reason for moving to monthly contributions, and that was to protect the state's interest against bankruptcy cases. That's a separate policy choice. But in terms of cash timing and volatility, the volatility impacts, and I think school districts would mention this as well, probably have an outsized impact.
Okay.
Thank you, Mr.
Representative Overmuller, you're back.
Yeah, thank you. I've kind of framed my question. I think I can ask it now. I'm wondering how you think about cash-based budgeting. Do you think of it as a kind of an alternative estimating system comparable or as a substitute for Craig, or do you see it as a fixed number that just becomes the number for appropriation purposes?
Mr. Chairman, I think in the purest sense, it would be a fixed number and a replacement to Craig in the short term. It would arguably not eliminate volatility, but rather it would delay that volatility by 2 years. So in the case of looking back to the 21-22, the legislature may not have had to make some of the budget reductions of 15% that policymakers made in the 2021 general session. So that would be one of the ways that it could be avoided. On the flip side, And this happens as well when you have a dramatic increase in revenues attributable to coal bed methane or natural gas development in Sublette County. Those communities and the state services associated with the burden of that increased economic activity, increased population, would arguably have to be delayed. So there would be no assistance to Sublette County, Campbell County, road construction, et cetera, because the cash would not have been collected until at least 33 months after it would be under the current system. So there are challenges and benefits on both sides, depending on whether or not the general trend is up or down in terms of collected revenues.
Just to follow up, so the cash basis, in your understanding, is basically a fixed number compared to the more dynamic estimating process that we have now.
Mr. Chairman, Representative, I believe that is correct, with one small caveat, and that is, even though it's a fixed number, there is no requirement to spend all of the money that is available. You can always spend less.
Thank you.
Yeah, so while we're thinking about that, the novel idea, it seems to me that regardless, I don't know, even if you move to cash-based budgeting, even after our discussion today, I don't know how you get away from having or needing the Craig forecasts. I mean, ultimately, as your cash-based budgeting, how else and where else do we get that customized forward-looking process for the state of Wyoming and where we're headed, at least where we think we're headed? Because it would seem to me being an appropriator, I'm always going to have my eye to the horizon because I've got to smooth this stuff. Even though I've appropriated for the entire, even if we cash budget for the entire session or for the entire biennium, as we enter the second biennium, if I believe that we're headed for a significant downturn or contraction of revenues, why wouldn't I be in and whether the executive leading the budget or the legislative branch who's appropriate, but why wouldn't I be modifying and adjusting my expenditures to try and feather back where I think we're headed? I mean, ultimately, I get the fact that if you say, we got this much cash and this is what we can spend and this is how we're going to spend it. I get that. But it doesn't do away with the fact that you've got that this is always going to be dynamic. It's not going to move away from the volatility of our revenue sources. And so all it is it says, all right, this is what we're fixed for the next year or the next 2 years. But overall, you're still going to be moving in one direction or the other, or potentially holding steady based upon some kind of forecast, which I don't know where that comes from if it's not from Craig. I mean, so I'd be interested in your thoughts,
Mr. Chairman, I would concur with your sentiments there. To Representative Obermiller's question, I was trying to say that for the next 2 years, it was a fixed number, and it's not Craig's position as to whether or not you should spend all or some or that sort of thing. But I think what would be of great interest, consistent with today's approach of the long-term profile that looks out 3, 4, 5 years, and Craig, I'm not going to give any secrets here, but I think it will not come as a surprise that we are anticipating the next 6 years of declining coal production, for example. And yes, we've gotten a bump, short term here, but the long-term outlook of Craig back in January, and I highly doubt that we will change this in October, has a downward trajectory on coal. And I think you policymakers would be interested in, well, what does Craig see for sales and use taxes? And if they see flat to declining revenues in other major revenue streams, that may modify the behavior, either in terms of revenue increases or restraints on spending to prepare for those trend lines in year 3, 4, and 5. One point here, just in all, this is not something I advocate for, but I think it's important to advise policymakers of what other states are doing. Many of our colleagues are eliminating their CRAG equivalents, and they're moving this to the private sector. So we met this summer with entities that would take over CRAG and do it themselves. Moody Analytics, that's a large part of their business portfolio, for example. They are not the only one. 100% of North Dakota's revenue forecasting is not done by CRAG. So if you're looking for alternatives, we don't have to have CRAG. Other states are eliminating their CRAGs. That is not my position, but I think for clarity, I think I have to make that note.
I mean, at the end of the day, I don't know how Moody Analytics does it any better. Nobody saw the pandemic coming. Nobody, I mean, except for Representative Schwartz. And so, I mean, nobody saw the pandemic. I mean, it caught everybody flat-footed. Every country, every. So I look at that, and I mean, Moody's can look at those things too, but at the end of the day, it doesn't matter who prognosticates our future revenues. They're incredibly volatile. And back to I think it was Vice President's point, they're never going to be right. The only thing you can be sure of with your forecast is it's not going to be right. It's either going to be better or worse. So
I'm curious why some states are doing that. I mean, that's got to be expensive for them to do. And I mean, and it obviously was a political decision, I presume. But what's your understanding?
Mr. Chairman, I think those houses can be very persuasive when they're in the business of garnering that contract. They can't, they do bring advantages to the table that CRAG does not have, and it is different in every state. They have access to more sophisticated models, and they have access to more national data. What they do not have is they don't have any of the state-specific data. So they're not using the well information that we use. They're not using our knowledge of our wind generation for sales tax purposes, pipeline purposes, that sort of thing. So I would not doubt that it is that politics contribute to that as well.
Yeah. Go ahead, Representative Schwartz.
Thank you. But I would think that the volatility of our revenue stream a consultant would want more money to do that work for us because of that volatility. Whereas it would seem to me, Craig, you guys are used to dealing with that volatility. Is that a false assumption?
Jump today. Do you know how those are back?
Mr. Chairman, I think I should mention two things. One, I don't think volatility is a huge factor, and by that I mean we're usually third in line. Alaska is the most volatile, North Dakota is the second most volatile, and we're third, and North Dakota has outsourced. So that is not a specific contributor to that. Secondly, I think that what they don't outsource, which frankly is a lot of what CRAG does, is the distributions. So they will tell you the total amount of revenue, and then we run it through our formulas. And frankly, that's a lot of CRAG's time because we have all sorts of exemptions, tied to price or coal exports, or now we have new federal leases that are at a higher federal mineral royalty rate. And then we, of course, distribute those funds through the $155 million cap, and now we have a secondary cap, and that type of activity, I don't think the external houses have an interest in picking up that
Right.
portion of the forecast.
As an example, when I was a county commissioner, I mean, we looked at the Craig forecast that came to Internal County, and we took X percent of that, and that would, at least from those sources of funds, that's how we established our the basis for our budget for the upcoming year. And I guess you could pay for that, but I mean, I think that's going to be one of the differences we'd see between what we have now and what would happen if we did that, sent that out. But anyway. Anything else? Looking up at my virtually attending members. Anything else? Anything else? Anything else for us, Don, on this subject? All right, well, we'll go ahead and we'll shut that off. Is there any public comment on this subject? Is there any public comment on this subject? Anybody in the waiting room?
No, sir, there's not.
Nobody ever wants to, we're just not exciting enough for the public to pay attention and can't fit. But anyway, with that, we'll go ahead and we'll adjourn for lunch. We'll come back. Did you have something?
Yeah, Mr. Just to follow up, it's my suggestion that we don't take any action on or any recommendation on cash-based buzzing. It's informative, it's interesting, but frankly, at least given our current financial scenarios, to me, it makes sense for us to stay with the status quo. And so if the captain chooses to make a selection, then that's what I would recommend.
Mr. Chairman,
Go ahead, Mr. Vice President.
I would concur with Representative Nicholas's statement in light of the fact of the other activities that this committee is looking at is to try to generate that significant increase in return from our investments. Bar that, we could potentially start to move towards cash-based budgeting, but I'm afraid if we did that, it would impede our ability to be able to do the other things to increase the revenues from the state of Wyoming at this point in time. So I think it would be very premature to continue this discussion because I think it's going to have negative economic consequences for the state of Wyoming in both the short and the long term.
Right, you can't do both. You can't do cash-based budget and invest this money for the long term. Can't do them both. So, so with that, go ahead, Representative Overmiller, did you have something?
Yeah, just one comment about this also from our desire to simplify things. My original question to Don had to do with the accrual basis versus cash basis. It's really important to stay consistent across the board. And the reason the state reports on an accrual basis is because it's generally accepted accounting principles. They have no option to decide they're going to do it on a cash basis. They are locked into generally accepted accounting principles. That's how this should be run too. We need to stay consistent. Thank you.
Thank you. Back in another life when I was a chief financial officer, we actually making the adjustments back because we reported income taxes on a cash basis, but we're required to file our financial statements on an accrual basis, and the bouncing back and forth is tough. It's very, very tough. Lots of room for error, lots of room for all kinds of things. And so, I mean, there's reasons to do it because it saved lots of money in tax dollars for that company. But without that kind of consideration, that kind of cost savings available to the state, it creates, it creates a huge burden to be able to have to move back and forth without having without having a clear cost savings or financial advantage to doing it. At least we've been able to ascertain now. So anyway, thank you for that, Representative Obermuller. Anything else? All right. So we'll go ahead and we'll adjourn for, we'll recess for lunch. We'll be back at 1.